Good morning, good afternoon, or good evening, everyone. Wherever you are in the world, welcome to the Books Price Action Trading Room. Today is November 17, and my name is Tim Stout. We'll be covering the first hours of the trading room this morning, and then Brad will come in right behind me or a little later. Today is Friday, so we have our week close, and what a week it has been. Quite some action, I think, after the inflation numbers and the job numbers came out. Rotation in the markets in interest rates caused a bull run probably on the stock market. And so we are determining today where the close of the week will be. Let's take a look at that weekly chart. I think it's interesting to see where we are. We have had the 3 legs down on the weekly chart, the wedge pullback, created a higher low. So based on this higher low, we are now creating, or we're trying to create, a new higher low after a wedge pullback. A wedge pullback is typically the last type of pullback. A wedge pullback also typically creates a moving average gap bar. That is because it just takes so many bars to create a wedge pullback that a wedge pullback is typically also a moving average gap bar. We have had a small moving average gap bar here in the first sort of leg up, but we definitely have one here. We're back at the moving average on the weekly chart. Last time I was on, I said we're probably going to close this gap to the 44.94. We did that and more. And so this great signal bar wants to get to 4600, and that region, there's a tiny gap here, 4603. The high of here was 45.94. So there's a gap between this low and that high. Let me just change the mouse color so that I get a little bit more visibility for you guys. I literally just walked in the house, so I'm getting everything ready at the same time. Yes, so here, this low, that high, there's a gap between the two. Bulls will want to close that gap and want to come in the middle of this bar, so that would be currently a little bit above 4600. We're trading at the moment at 45.33, so that will probably not be for this week. There's also a pullback probably that has to take place because this is getting very climactic, and we need to come down to find more bulls willing to buy at probably these prices around 44.20, 44.25. On the monthly chart, we had our 3 bear bars on this leg down. So we had August, September, and October being bear bars, closing on their lows, setting a measured move on the weekly chart, having those 3 legs down. So 3 legs down on a lower time frame is 3 bars forming like this on the higher time frame. So you can see this a lot on the 5-minute chart as well, where you have 3 pushes on a lower time frame. That is a wedge. We have a strong bar that is currently on the monthly chart forming, but it's a high 1. So this is definitely a trading range. This is a high 1 that's being triggered. We're at the 50% pullback from this leg to that leg. Bulls are breaking even if they bought June. Bulls have not broken even if they bought July, only if they have scaled in lower. So will we actually get to the July close of 46.63? I don't think so. I think this is a high 1, and it's going to be a disappointing entry bar. So November at the moment is strong. We're at the top of November, but I don't think by the end of November this will be such a strong bull bar. I think it's going to have a tail because it triggered a high 1. I don't think the high 1 signal bar will be as powerful as it is looking right now. On the daily chart, so we had our sell-off here as well, so you can see the same type of wedge, 3 legs in on the daily chart. So leg 1, this size. Leg 2 was larger than leg 1, and so expect leg 3 then to be the same size as leg 1, with leg 2 being slightly larger. Leg 3 is going to be the same size. So if I project the size of the first leg to the size of the third leg, that almost was identical. So we had our reversal up. When it went above this new high or this high, you have to assume that we're going to get some type of measured move up from that range. So we reached that a couple of days ago around 44.24. Now the bulls didn't respect any resistance here. They are just hammering to the upside, and we now have 45.12. That was a 1 hour based on November 10, and we reached that 3 days ago. We're now creating a high one entry. So yesterday was a pullback because it went below the prior day's low. This was the first pullback. This was the second pullback. So technically it triggered a low 2, but in such a strong rally, a low 2 would most definitely fail. And you can see that the market reversed yesterday into the close, had a good close and a bull bar, but it is a high 1. So are we still in the breakout phase? And is a high 1 really working? Or are we not in a breakout phase after this pullback, and is then a high 1 less likely to succeed? I think today will not be as bullish, as powerful as it seems to be here. I think this is going to be disappointing. I think there's more profit takers here above yesterday's high than that there are actually bulls willing to scale in. Their stop on the daily chart is around 43.50, right? Or here, if they want to, at the 44.20. So I'm interested to see what happens here. We could, of course, go a little bit more up, maybe here to this close, 45.55. But I'm assuming trading range and maybe even a little bit bearishness after a high 1 trigger. So today triggers a high 1. That's, I think, important. Then on the 60-minute chart, let me remove all of the previous lines that I had here. You had this big explosion to the upside on the CPI news release. So that was, of course, a big bull entry bar. The question, of course, is on these news events, is this an entry or is this an exit long bar, right? Is this a gift after a prolonged bull rally, and do you want to take profits at that close? Or is this actually a nice entry, and are we going to get a measured move up? Well, chances were that we're going to get a little bit more up, but bulls want at least a 1 hour based on the size of that bar. They would want to see a 1 hour based on the size of those 3 bars all the way to 46.07. And right now, there's not enough follow through. What they would want to see is a channel that basically goes directly to those targets, and instead we're drifting sideways. So can this become a final flag? Can this go above these highs of the last 2 days, form a failure and come back down? I think that's a possibility. I don't think we're going to come down here to fill these bars, but there's no urgency yet for the last 3 days on this 60-minute chart. We're at 4,500, 45.30. That will probably be a magnet as well for weekly expiration. So I'm expecting maybe more of trading range than a big bull trend. But that said, I will gladly let myself be surprised and then trade what I see. So it's good to have a premise, but I'll throw it overboard as soon as the price action tells me to throw my premise overboard. And so if we're expecting a high 1 to fail, what are we doing? We're selling high and we're only buying very, very low, right? So that will be premise going into the day. Let's see. So that was overnight. Let's see 15-minute overnight. Also here, let me get rid of the lines that were there. Well, you can see overnight as well, right? So we had a range, we had a triangle here. So we have new highs and new lows. If we make lower lows and we make higher highs, by definition, we're in some type of a triangle. We can break out on one side and set a measured move. We can break out on the other side, set a measured move. But typically you break out on one side and you go back into the range, and there's some more of a horizontal range forming than an immediate breakout to one of the sides of the triangle. So the triangle will have magnetic effect, as we say it. It's going to drag prices into the triangle after a failed breakout. Overnight, we had a channel with a failed breakout above the channel. We're now back at the lows of that channel. So spike and channel, but a breakout above a channel can mean two things. 75% of the times you're going to go back into the channel, at least to the midpoint. 25%, you're going to get some type of a measured move, the size of the channel, so that would be around here, then some type of wedge stop, and then a return to the top line of the channel, and quite possibly the mid size of the channel. So it is showing some type of a climax if this channel would have been broken to the upside and then further. Right now it proves to be resistance, and we've drifted back down to the lower side of the overnight price action channel. So that is that. Now let's look at yesterday. I've only traded the morning yesterday, so I haven't actually seen the price action at the end of the day, so this is the first time that I see it as well. But we opened slightly above yesterday's low. Okay. Now we haven't gone below yesterday's low in many days, right? So last time we were still in this bear trend and we had that surprise breakout. So all of this bullishness, we've never been below yesterday's low. So if you think about it, there's no bull in the planet that has yet had the opportunity to buy below a daily bar. So as soon as we go below yesterday's low, you got to assume that there's bulls waiting there to buy at a discount. They've been buying above the 60-minute moving average for all of this time. This is the 60-minute moving average. So all of this bull rally since November 10, we've been above the 60-minute moving average. We've been buying in the ranges of yesterday or above yesterday, and this is the first time that bulls get the chance to buy below yesterday's low. So you have to find a long entry here and then assume trading range, especially in this range where you see double tops, double bottoms. It would be like the easiest trade going into the day like this is to find an entry long below yesterday's low. There's such a high chance that there's bulls here waiting to buy at a discount that they haven't been able to buy for 4 or 5 days, that you have to assume that they'll be waiting there and find the long entry there. So we opened with a bull bar after 3 bear bars on the close of yesterday. Bar 2 set actually a double bottom. Bulls bought around the lows of bar 1 low, but they exited at the close of bar 1 as well. So some bulls would have bought the close of 1. They would have scaled in, maybe here for 50%, 1-to-1, maybe here for 2-to-1, and then get out at their original entry and then profitable on their second entries. So that is what I think happened there on 2. 3 was a pause bar. It created the 50-minute bar, of course. So the 50-minute bar low was here. The 50-minute bar close was there. 2 times risk led us to 45.26. We hit 45.26.25 and then sold off. So bulls were making money. They were actually making 2-to-1 on the 50-minute chart here. So bulls would definitely be hungry and looking for getting long below that price as well. If they already made 2 times risk at this price, then what can they make on no buying at this price? So that's what I traded actually. So I traded here that 3 long. I bought above 2 and then wrote it there. So you had one chance to get out at the 6 close or at that high, then got maybe spooked up by 7. But you know that bulls are in charge, so you'll get a second chance to sell or exit longs at the 6 close. That happened, and then we drifted down because we were so close to yesterday's low. Chances were that we were going to get below yesterday's low. So 11 was another bar for the bulls to get out. If you buy the 9 close and the 6 close, or even the highest tick of the day, bar 11 gave you every chance to get out. Break even. There was also a pullback on the 50-minute chart, because on the 50-minute chart, this was bar 9. It was a big bear bar. So you have to assume that we're going to get back to that close of that big bear bar. I can pull the 50-minute chart here. So we had big bull bar, and then we had a big bear bar with a pullback. Price was going to come back to the close of this big bear bar. And that is the close of 9. So close of 9 here, if you sell, you put your stop above the high of the day, you sell a 50% pullback, you have a 1-to-1 chance, price comes back to that close. I shorted there, and then I bought here the same thing. I had I was thinking that we're going to go back to the 9 close indeed, and then we had bar 12. That was a bull bar. I didn't go long for the bull bar because I was scalping short, but then I did do it here again. So bar 15, if you think of it, every multiple of 3 is also a close on the 50-minute chart. So I did have a stop above here and scalping it back to the 15 close. I didn't get filled there, so I sold at the close of 16, going back to the 15 close. A couple of points there, and then we got below yesterday's low. So the only thing to do here was find the long that you need to take, either by taking this one above 21, or taking and then buying more here, or waiting for more confirmation. And then as soon as you see 28 go above 26 lower high, you know that we're now bullish, right? Lower high, lower high, lower high, lower high. And so 26 was the last, or 25 was the last lower high. As soon as we break that with 28, good chance to buy a 28 close, 30 close, and then all the way at least to the gap of the 12 low. But you could even hold for the 6 close, because that is ultimately where we went to. You can see some bulls bought this. They didn't get out. They bought more, and they exited at their first entry, the 6 close. You could also look at a measured move on, for example, the 50-minute chart. So that would take us to here, 22.75. You can see that some bulls also used the measured move on a 50-minute chart. If you look at the 50-minute chart here, well, let me take it into a separate tab. So this was yesterday. If you look at the 50-minute chart here, you can actually see a very nice looking wedge, 3 pushes and failed breakout below yesterday's low. You have this bear bar here. The high of that bear bar and the low of that range form a breakout range. 1 bull bar above the breakout range, 2 bull bars above the breakout range. The breakout is probably going to be successful. And so at the minimum, you're looking for a measured move to the high of that bear bar, to the low of the range, 45.23, right? So you can buy anywhere in here, even taking this 2-legged pullback on the 50-minute chart and then go long, or look on the 5-minute chart for entries that will take you to the 50-minute chart measured moves, okay? That is how you can optimize your profits a little bit better. There's 3 things that go into a trade, if you think about it: the stop, the entry, and where you exit. And most traders that suffer with profitability do one of the 3 typically wrong. They usually don't do 2 of the 3 wrong. They usually do 1 of the 3 wrong. They either have their stop at the wrong location, and so they're scared, and therefore they're trading too big. They either enter way too high or way too low, or they don't take enough profit for their trading plan, right? 1-to-1, 2-to-1. If you don't take enough profits, but you take full losses, your profitability is impacted enormously. And most traders, and you know this probably for yourself, but most traders don't take enough profit. They don't they don't have faith in measured moves or targets that work that way. So if you buy anywhere in here, what you want to see, especially after this rally, what you want to see is 22.75, right? You can't take a trade here, go in for 22.75, putting your stop below 26, because your risk reward is not even 1-to-1. But you got to trust that this will also pull back. It's a moving average gap bar short, so it's actually a short entry. I think the market is way too bullish to take it, but you can take the short, looking for these gaps to be hit. You can find a higher place to put your stop, like below 38, but that is actually a target for the bears. So I would actually look at buying low enough for getting to the 22.75. Now, many of you know I trade mostly by finding a target first, and then defining where my stop is, and then finding an area of entry. And if you think about that 22.75, your stop is below the low of the day. After this reversal, you don't want to see prices come back to a new low, so your stop is safe here. And this would be the area of entry for an actual 2R or 2-to-1 trade. Stop safely below the low of the day, entry to an established measured move. The breakout was confirmed. You have that two-legged pullback on the 50-minute chart. So somewhere in here was a very good level to enter for long that you could just take as a Walmart long, right? You can manage in here, then you can short in here, you can buy in here, you can sell in here, you can be very active. I'm going to make your broker very happy. But beginners should establish these targets, should establish their stop location, and then just look to see if there is an entry at a price that makes sense. Okay, so if I would take it not for 2-to-1 but 1-to-1, well, I could say this is a high 1. I'm just buying this high 2. I'm putting my stop there, and I'm putting my target there. And then I see this pullback. Yes, maybe I buy more. Maybe I just hold on. But I'm trusting that that measured move will be hit, especially with these two bull bars climbing above that 50-minute bear bar so big. You're going to have to trade long until at least those targets are hit. Right? The 6 close gave you some extra information, but that doesn't always get hit. I trust more in a measured move than in this price coming back to the 6 close. So I thought 22.75 was an excellent price to get to. If I had only stayed around to trade it, that's what I would have done. On the downside here as well. So if you have faith in that measured move to below 3, so you have to below 3 or to below 4, like whatever you do, but you just hold on. Now, if the market is bullish, measured move targets for bears will be tested but not hit, right? Because the goal is to trap the bears. So you can put a measured move on the 50-minute chart down from that level. It was probably better to just look at that pullback and then take the measured move from the pullback to that level. So if the market is bullish, bears will still get measured moves, but they will not be the full-size measured moves from ranges. They will be smaller, and the bigger ones will actually fail to get there. And I think, top of my head, Al had mentioned the same measured moves that would probably fail to get there because the bears are just not strong enough in this market to get to big targets. Okay. So that was yesterday. How about today? Well, I mentioned already where we are on the overnight price action. So let's prepare ourselves to see where we are on Globex high and Globex low. 45.3950 is a Z high of a Z day. One ticky down. And for Zzw. 2350. That is, of course, at the close of yesterday. There you go. I don't like the big fat lines. They take too much real estate on my screen. Globex low here. Flowbacks, what is that? Globex high. Call it ETH high, call it ETH low, call it Globex high, call it Globex low. It's all the same thing. What we mean is the price action overnight. The most important price action on the Globex or on the ETH is actually the price action that happens right before the market opens. What is further in the past is less important. The range here is actually established by real orders coming into the market or being prepared. So the range right before the open of the day is actually way more important than after. So that's set. Let's take a final look at the 50-minute chart. So 50-minute chart is trying to break below a wedge. We had one push here, two pushes here, three push there. And so the bears, they want to have at least a measured move of the third push. Well, that's what they got. But they're more ambitious than that. They want to have a measured move down of the whole wedge. That will be 45.20. We've closed all the gaps to the downside, I would say. Yeah, and there's one gap to the upside here and then there as well. So let's see what happens. We are very close to yesterday's close. Yesterday was a trading range. Are there any gaps open from the trading range on yesterday? Nope. So the bulls did an excellent job of getting higher and higher without leaving behind any open gaps for the bears to target to. So there's no gaps on yesterday. All of the gaps from here have been filled. There's probably one gap here Nope, there's no gaps here. Wow, excellent job done by the bulls. The only gap is here to November 14th. So let's give it a couple of minutes and I'll have a sip of coffee and then be right back with you guys at the open. In the meantime, any questions, any comments, any shouting, just tag my name in the Discord so that I can have an easy look at that. I will also open the questions box on the webinar so that any questions you have, you can ask them in there or just in the Discord with my name tagged. And then when there's a quiet moment, we'll take a look at what's has come in there so that we'll go over whatever you have burning as a question. So market opening around the low of the bull channel from yesterday, more at the midpoint of the channel from yesterday. Was a tight channel, so not be surprised if we break to the upside with some measured move. But it's a trading range. We're inside yesterday's range. Typically, we cross either yesterday's high or yesterday's low if the range is not too big. So given the context, you would expect yesterday's high. But what if we don't and we go all the way down? So it's not a safe trade to just put on a long right now and betting that we're going to go above yesterday's high, because the chance that we are not is going to cost you 20 points at the moment. So that's not a strategy. But let's see what we're doing. Close to yesterday's close. And we're basically pulling back from 4 bear bars on the 15-minute overnight market. So 4 bear bars on the 50-minute chart is a big bear bar on the 60-minute chart. We can also see that here. So big follow-through bear bar on the 60-minute chart. Probably want to close that gap. We just did. So there's no immediate targets that we can trade towards. We just have to wait, I guess, a little bit to see a range established and then find the first swing. In a trading range environment in general, the first good swing of the day or the first good trade of the day typically comes from a high 2 or a low 2. And if you think about it, it takes at least 6 bars to set up a high 2 or to set up a low 2 in a trading range. So you need 1 bar and another bar to set up a high 1. No, even more. So you need a bar, a pullback, and then another bar to set up a high 1. You need another 2 bars to pull back again and set up a high 2. So it takes 5 bars to set up a high 2 or a low 2. Usually it takes about 8 bars to 12 bars to find the trade of the day. So around bar 8, 10, 12 is where you might be able to find the swing of the day. Yesterday it took all the way till probably somewhere in here, bar 30, where you could find the swing of the day for 12 points. So what I'm basically saying is your patience is rewarded. Hastiness will be punished in an environment like this. Yeah, there's no gaps to the downside. The only gap is way down. There's gaps on the 50-minute chart, like there's one here, 45.1775. We're so close to yesterday's high that we might not go there first. We might actually go up first and then try to close that gap. We're still breaking out above yesterday's 65. Did we already get a measured move to yesterday's 65 up? Yeah. Oh, we did at the open. Well, that was the target at the open. Did we already get a measured move to yesterday's 65 up? Yeah. Oh, we did at the open. Well, that was the target at the open. Okay. So definite profit taking right before the weekend. We're going below Globex low. But how much downside is there below 45.19? Right? All of this was trading range. There's no obvious gaps here except for 1775. We're at that moving average. The 60-minute moving average is not so far below us. We're probably going to hit that today. But there's not a lot of obvious targets that we want to get to. Okay, so what would be, if you sold the close of 1, what would be your target? Well, stop above 1, selling the close of 1 will bring you to 1375. What happens if we go above bar 1? Some bears have sold the close of 1, and they will have their stop above 1 trying to get out. Bulls will then try to take over and set up a measured move. The size of the 2 low to the high 1, that's 33.50. And other bears will sell the close of 1. They will sell more at the high of 1, trying to get out at the open, which is 22.25. Okay. One of those scenarios will come out if we go above 1. So we either get a measured move up, or we'll come down to the open to get bears out. And of course, if we don't go above 1, then the bears are still trying to get to yesterday's bar 70 low. But this is moving average. Look at the times that yesterday the moving average was a buy location. Since bar 61, it was. So you're going to sell below bar 1, right below yesterday's high, in a raging bull trend. In a Friday that is a very bullish week? I don't think so. But we said this is a high 1 bar, so we want to probably trigger the high 1. So on the daily here, you can see that today, after a pullback, is a high 1. We haven't triggered the buy yet. We'll probably want to trigger the buy and then see if there are any buyers. I don't think today is going to be a big bull day. I actually think that today might just close inside yesterday's range. So if we do go up somewhere here, then I expect a reversal at some point and us closing the week around 4,500 or 45. Yeah, yesterday's close will be a magnet, but in yesterday's range, I expect the close today to be. Where is this week's high? Is this week's high here, the double top? It probably is. Yep. So do we want to test yesterday's high, 45.36 and a little bit? Well, the bulls probably want to, but it's an excellent place for a short swing back into yesterday's range. And we're failing to break out below the Globex low. So getting the Globex low, I thought I had a chart, yeah. So Globex low, you can see this wedge is now becoming a measured move down. There's a ledge here as well, just saying. But we're at the measured move already. So the measured move to the low of that bull bar, the whole range down, 45.20. We got it. We tested it again at the open, and we're now failing to go much lower. So I'm expecting some bullishness around here in the next few bars. I guess we just have to wait a little bit more. I scalp a lot towards 15-minute closes. So if I just take this for a second, I cannot do that with this indicator. But I scalp a lot to 15-minute closes. So if you're in a trading range and there is a big bull close to a 15-minute close, so you can see this on the chart of yesterday, then bulls will actually be scaling in lower to go back to those closes. So this was a close yesterday, 45.1675. What is this? So that's bar 39. 39 is a multiple of 3. So this was a 15-minute bull bar close. On the 15-minute chart, your stop is below 26. So you could actually just limit order buy the 47 and low, and it goes right back up to the 39 close for a 1-to-1. Okay? So if you think that a strong leg like this will get back to such a close, or if you think that a strong leg like this will go back to the close price, then there's a lot of limit order bulls that will be buying 50% pullback to the tick, trusting that with a stop here, it's higher chance to go back to that close. You could have done that with the bear bars as well from yesterday, where this bar you could sell, put your stop above, and it comes back to that close. You can buy here, it comes back to that 50-minute bull close. So that's just a lot of price action indicating that, what are you going to use as a target? I use a 50-minute bull bar close or a 50-minute bear bar close as a nice target because the high chance of coming back to it, right? Can we break below the 45.14 for a measured move down? I don't think we can, but we want to, right? Measured move down should be 45.02. 3 bear bars, so the 50-minute chart is becoming a big bear bar. But we haven't reached the measured move even on bar 1. So I'm still waiting to see how this 15-minute bar is going to close. We still have 3.5 minutes left, and the appearance of the 50-minute bar can completely change in the last 3 minutes. Bears need a close below 69.70 from yesterday. You can see that is the last bull run. So if we can close below it and then get follow through, 45.02 becomes a bear target. That would be crazy because we went below yesterday's low, Wednesday's low once, and that failed. And so there's a very high chance that we go below Wednesday low again. Wednesday low is at 45.1075. And so you try to break, bears try to break below it once. Bears are now trying to break below it twice, or at least sell higher and break even on their first entry. So we're probably going to go below 45.1075. But again, where's the risk and where's the reward? So 45.1075 with a stop above 1. You can only enter 1850 or higher, and that's for a 1-to-1. If you want a 2-to-1, you can only enter 21, 25, or 21 for a 2-to-1. Okay. And that's probably why the bears sold the high of 2 there. Now, if I missed the sell, and I still think it's going to a target, I at least don't look to buy towards the other side, right? I'm not looking to go long here. If I miss the sell for 45.1075, because chances are that we're going to get there until we break above the 2 high, which was the entry point for that short. Chances are higher that we're actually going to break 69.70 and then 45.1075. But it's disappointing for the bears that we're not breaking below this higher low, 45.14. The bears from bar 1 are still stuck, like they haven't gotten their profit yet. That was 13.75. So it looks good, but it's actually not that strong for the bears. Okay, this is not a breakout. The breakout needs to be closing very far below that 45.14 before we can say this is a breakout with a measured move down. And they came to within 2 ticks of that low, but they're stalling, and they're not. This is not a successful breakout. So I'm much more looking at scalping towards that 3 close. For example, if the close would be here and bulls would come here, we could actually be selling back down to the 3 close, stop above 1. Well, what are the chances that we're not going above yesterday's high? I think that we're going above yesterday's high. I don't think we're not going to even try to get there. That was a very good-looking high 1, and I think bulls will definitely trigger the buy signal today. So if we can get actually to this range, set up a nice little double bottom, wedge bottom type of thing, then there's a very nice long to yesterday's high. Okay, so bar 3, close of the first bar on the 50-minute chart. 50% pullback is to 21.50. Failed breakout. You can argue double bottom. So 69.70 was the start of a bull leg. We now have a double bottom. Bulls want to start a new leg up and now get to yesterday's high. But bears will be selling here the 50%. And bears will also be selling 23 for 2-to-1. Bears already selling above 3, trying to get back to the 3 close. So that's limit order scalping. Selling with limit orders above, bars confident that we're going to go back to the 3 close, or at least the 2 close, but probably the 3 close. So bull's trying, but this is a high one above a bear bar, not a good buy. It's actually a better sell than a buy. If you're selling here, you can't put your stop above 1 and go for the 3 close. If you're selling here, you need to go at least to this range for a 1-to-1. If you're not taking a trade that is at least a 1-to-1, you're making life very hard on yourself, because with the commissions and everything, you need to be right more than half the time. If you're already taking just 1-to-1s, which is already hard enough. So if you're taking these very small reward, very large risk type of trades, selling above 3, well, where do you put your stop? You can only sell above 3 if you put your stop above 2, right? Because then you would actually have a good trade. But what's the likelihood of that stop to be triggered? Well, that's quite big as well. You can see if you sell the high of 3, stop above 2 for the 3 close, you actually now have almost a 1-to-1. But I don't think a scalp like that is going to be 80% of the time profitable. So I would not sell above 3 with a stop above 2. I would sell above 3 with a stop above 1, but then my target is way too far away. So there is, for me, no trade above 3. I see some good questions coming in. Keep them coming. I will find time to address them either now or at the end. So just keep them coming and I will get to them. And if you happen, of course, to be exiting earlier, then there's always the recording to get an answer to the question there. Just don't give up on me. I will try to answer. I will try to answer. Okay. So can we get back to the 17 close? Can we go lower than the 17 close? The 50-minute bar is still an inside bar, so it's got still a good 9 minutes to go, but there's not much movement. So what does that tell us? Do we want to sell low in the slow-moving trading range? No, probably not. You can sell. Can you sell below 4? I think you can sell below 4, but you'll probably find more bulls there than bears. So what probably will happen is that either we get a little bit here, or we go back up, and then you can get out break even on the next bar. I don't think this is going to run down immediately. If it does, then 4 was a pullback of the bear rally, and it's going to go to 1350 in that case, which we had already defined as a target. So bears will try to sell, but chances of a low 1 working in this environment are just not all that great. Did I just say that whole thing muted? I guess I did. Okay. I said this was the entry for the 1-to-1, right? So the big bear bar on the 50-minute chart, this is the entry for 1-to-1, which I took. But I will get out of it at the earliest sign of disappointment. So you're selling here with a limit order, stop above 1, trying to get back to the 3 close. That is 50-50. It's not a great trade. It's not 3-star trade. But I think it's in this context it works only because I think we'll go lower to the Wednesday low. So I'm taking a scalp more based on that assumption. If we go to the Wednesday low, and I think we will, then we're probably going to do it before we go above the 1 high. I think we'll go above the 1 high. I think we'll go to the Wednesday low. But I don't like 5, so I want now the 3 close for my profit. And otherwise, if we go above 5, I'm out, right? I'm taking the scalp. I don't want pullbacks on my scalp. And I like, of course, that I'm selling at the exact high of 5, but I'm not going to hold this for 20 points. Like, this is not the environment to find a swing yet. You would need a bear bar to close on its low below the range of 4 and 5, but your target is here, Wednesday low. So there's not much left to the trade. That would be a measured move to 1175. And you can see here what I said. If you sell below 4, you actually need to scale in to get out break even. We'll probably go below 4 again. So if you sold below 4 and you see 5, you think, darn it, I sold a low 1 in a trading range. That's not going to work. There's a high chance, actually, if you sell below that bull bar where bulls have a stop, that we will visit that again. Right? On that premise, we have to go to the Wednesday low again. So we went below Wednesday low once, we'll go below the Wednesday low twice. 1075 is what I'm thinking. Still an inside bar. So who's disappointed here? Bears are disappointed here. You can see how the bulls are trying to trick the bears. So the close here is 17. The lowest tick was 17.25. So if this reverses back up, bears like me will have to get out of their scalp short. And that triggers the big bull bar that can then follow. Right now, it's still looking as if we're going to get a second chance to get to the 3 close. But if we go and grow this into a big bull bar, bears are trapped. Okay? So limit order market. The bears are running. I don't think it's okay to be long here. I think we're going lower. But okay to exit shorts if 6 is a bull bar or 1 tick above it, or 1 tick above 5. If you had the entry point there, then you probably still can get out break even, whatever bar 6 is going to do. Bulls are trying to get to 22.75. This one, bar 78 close. I'm giving up on my short here because they should have been hitting it, and the fact that it went there and missed it by a tick shows me that we're trapped. So I don't want to hold. Even if it now hits it anyway, I don't care. Right? 6 inside bar, 3 bull bars going sideways. Can you buy above? Probably not, right? Sideways, probably more bears in this area still wanting to go down. So it's not a good long. Now this was a inside bar on the 50-minute chart. So will there be more buyers above than sellers? I don't think so. It's still undecided. It's a small range. The range will double. I still think we're going here, and I still think we're going there. So we're right in the middle of the 2 places where I think we're going to go. Okay? So I think we're going to go to yesterday's high and to the Wednesday low, and we're right in the middle. So you can either sell here and hoping that we go there first, and then having to sell more when we go there first, which is not a good strategy, because then what if we don't? So it's better to wait. And if we go here first, you can find a long setup to go to yesterday's high, or if we at yesterday's high or even higher, 45.36 and higher, there might be some shorts to get back to Wednesday's low. But it's more likely that we're going to visit Wednesday's low, 45.10.75, before anything else. The bulls have a high 2, but it didn't trigger yet, and it's a high 2 on an inside bar, so outside, inside, and now inside. So I would not want to buy anywhere in here. If we go higher, we're probably just going to go to the 78 close from yesterday. The 60-minute chart on the Globex closes at the hour. So big bear close, trying to break below a range here. Zoom in a little bit. Its target probably wants to be 45.11. There's a close here, 45.09. I think that's going to be too far. We'll probably want to get back into the range. But it was a good close. But look at the big bear closes from the last couple of days. We had a big bear close, doji, big bear close, doji. And this is even a big bear close with a long tail. Like here, we're probably going to get a new low, like the other times that we had that. But we need to go higher to find more bears. double top, low 1, low 2, but look at the tail from 7, not a good short below 7. Now interesting on bar 6, interesting on bar 4, you could buy the close and at least make 1 point. You could buy the close on 5 and make 1 point, but you couldn't make 1 point buying the close of 6. All of the bear bars till now, you could have sold the close and make a point. So the bulls are not very powerful. We probably need to come lower. On the 15-minute chart here, you would say different, right? We had a sell-off. We're trying to get back to the 45.70 close. We had the end of the sell-off with that inside bar. Probably need to go higher, but on the 5-minute chart here, it looks like we probably need to go lower unless we can get a big bull breakout above double top a 5 and 7. I'm still flat again. So if we're looking at Wednesday low, stop above 1, this is the 2-to-1 entry price. So if this is your risk, then this is 1 reward, twice reward. So it's not that crazy that we're stalling at this price, because this bears love to sell this price. So there's probably more bears at this price actually than that there are bulls. But if you break through that price, bears will realize that they need to get out break even on that price. So if we get a bull bar, we'll come down to that high and then reverse back up. That's a sign of bears getting out, taking a run over the hills, and then we could quickly find ourselves above bar 1, and even a measured move, the range of the opening range, right? But right now, this is still a very interesting price for bears to sell with limit orders for the Wednesday low. It would have been much more helpful if there were more gaps in yesterday to drag us down. So I gave up on my scalp and I put it back on. But it's a measly, measly 4 points. If I get it in the first place. So what do bears want? Well, bears have now sort of a horizontal flag that they want to break out of to the downside, which would take us to 1175. But outside, inside, failed breakout to the upside, but also a failed breakout to the downside. This bar 8 didn't even go below 6. 9 had to do that for them. And we're at the 17 low. We just get a fill. So will the bears take cover here and will we reverse back up? Or will the bears hold, convinced that we're going to get a little bit more down, a second leg down? What would a leg 1, leg 2 mean? Well, that would be around 975, a little bit below Wednesday's low. But where are they? They're covering instead of adding, right? It's not a bear swing. It's a bear leg in the trading range, which is no surprise if you see yesterday. Right, so we're below 17. I said we were going to go to the low of 4, and that's what we tested here as well. So some bears will have sold, will have seen 4 as the pullback, bear trend, pullback, continuation. So as soon as that pullback ends below 4, they'll sell, and they'll get very disappointed. They might sell more or just get out break even. But it's very common for that to happen where you go below it once, it fails, you go below it twice to pick them back up, and then a quick reversal back up. Okay. So I got out at the 45.17 instead. Now waiting to see if we can get a breakout. We need a new low of the day to put the stop above 8. So stop is still above 1, and that's the problem for the bears. They want a lower high so that they can actually put some more size into play. Right? If your risk is 10 points and you want to risk $1,000, you can only trade 2 contracts. If your risk is 8 points and you want to risk 1,000 points, well, I can't do the calculation right now, but you probably can trade 3 contracts. But you can only do that, you can only lower your stop to above 8 if we actually have a new lower low. We don't. So stop is still above 1. Market's deciding if the breakout below this range is going to fail. It's going to succeed and we're going to get a measured move down. Or is this breakout going to go back to the high of the double top 5-7 and we're going to get a breakout to the upside and yesterday's high. It's becoming better, It still needs to take out the low. 1425. If we get 1425, there's a high chance that we'll go back to the 5 low and then sell off from there, because that would be the 1-to-1 with the stop above 8. So we actually need to go back up to sell there to come down. If we don't, then bears probably have a lower target in mind than I do. It is not going below 3, so it's very disappointing again for the Z bears. They closed a bear bar on the 50-minute chart, so that's good. We went below the 50-minute bull bar, so that was below 5. So we're probably going to go below 5 again, unless the bulls can now see a double bottom, a high 2, and a trend reversal up. Now from a larger range, so that will be to 28.75. It's not bad. It's looking good for the bulls. If they can break the 8 and the 7 high, then yesterday's high in 28.75 are what I want to see. I think every bear realized that 9 closed so disappointing that if you sold 8 close or below 8, you sold below 8, you got a chance there, right, to break even. You have to be quick, but algos are quick. So every bear realized that the second leg was not happening. We didn't go below 3. So this is now setting up a long, but also there we need a confirmed breakout above 8 and not a failed breakout above 8. There's more bears here than bulls for now. We need a confirmed breakout above 8. So a big bull bar above 8 does it. 2 or 3 small bull bars above 8 do it as well. And the stop then is below 10. Start of the leg. So I'm not buying anything in here. I want to see a breakout first. The range is small. The range is, 8 points? That's a tight trading range. So tight trading range, you can't really trade with stop orders. So that's why we traded with limit orders. Here, you sell here, you sell the close, you sell with limit order. Back at the 3 close, you sell, you cover shorts. Back here, you can sell here, you can sell more here, and then get out. Same thing happening now. So we go above a bear bar on the 50-minute chart. That means on the next 50-minute chart, so in at least after 12 minutes from now, we'll probably try to go above there again. Bears will want to get back to the 9 close or to the 9 high. So they'll sell to that. But again, it's limit orders in a very tight range. So you get a point there, you get a point there, you get 2 points there, you get 3 points there. And in the end, the only meal you'll have gathered is dessert, right? You still need to get the main dish from a swing or something. So we're at bar 8, we're now at bar 10. So a swing could set up any minute now. Bar 8, bar 10, bar 12, they're all good candidates. But I don't see it yet from here. If you buy the 10 close, you're assuming that we're going to yesterday's high, and your assumption is probably correct, because a 1R is to 26.50, so that has a good chance. And you're buying for 37.75, measured move of the range, right? So you're front running a potential breakout. Bear should now be out, right? You should not be short. With bar 10, Well, you should not be short after bar 9 gave you so much disappointment. A lot of traders are hopeful when they see bar 9. They get disappointed, but they're hopeful that the next bar is going to be a big bear bar. But you need to be fearful instead. Bar 9 was not what you wanted to see. It could not break the low of the day. So you should immediately act and get out and see what happens next. If bar 10 was going to be a big bear bar, well, you missed the trade, but you did the right thing, being disappointed and getting out at the 9 close or above 9, but certainly when 10 was starting to reverse up, right? Getting out of that short also frees your mind to potentially look at what's going on the other side. So it prepares you for potentially getting long. Because if you're in a short right now, you're still like you're starting to pray and hope and calling all types of methodological creatures for price not to go above 1 where your stop is. You might even start negotiating with your stop, like maybe I just put it here. That's not the way to go. Like in these type of environments, disappointment is an immediate response to act and get out. It's a trading range. It's going up. It's going down. Bulls are getting disappointed. Bears are getting disappointed. So if I'm disappointed by 9, 9 should have gone below 3. Okay. We can still go there now, but on that trade, you would definitely have to exit as soon as you see 9. So someone is asking a good question. So in a tight range like this, would you still attempt, if you scalp here, would you still attempt to get at least 1-1 or 2-1? Yes. I'm not trading for a point or 2. That's bad risk reward. So either I find a different stop or I find a different target. I'm just not interested as well in a 1-point trade. Like the commissions are, what is it, like 10% of that? Like I'm just in general not interested in points. Looking at point scalps takes your eyes away from the 20-point swing. So the risk reward is bad. The trade is bad. Looking for it is bad. You might just get way more. So here there were 4 points, not 1 point or 2 points. There were 4 points there to get back to the 3 close. So it just frees your mind to not look at those. Like I have not seen anyone trading scalping for 1 points in my life. Doing this happily for 40 years. Never seen it. Now, do I think there is a point to sell if you no? Is there a point to make if you buy the 10 close? Can you then get a point? Yeah, probably. But I mean, I want food, not a starter, right? So I don't care about what algos are doing. Plus, like the algos probably have way better commissions than we do. And they can easily calculate their effectiveness. Like they can easily backtest 20 years of data on a situation like this to see if that works for them. These quants in London and New York do nothing else. But for me, I don't have enough experience with this exact pattern to say if that selling or buying the 10 is going to work for 1 point. So I'm not competitive with the algos there. No, this is good, right? This is now a close at the high of that range and a close above the high of the range. We're getting some follow through, but our measured move to 2925. Where do they need to buy? They need to buy. They probably want to get 2 times risk reward. They need to buy 21. For 1, they need to buy 23. So if they buy the close of 11 and put their stop below 10, then 28.75 is what they want. But you can also still see it as a 2-legged pullback for the bears. That's what bears want to see. You can see it as a 2-legged pullback for the bears and then another leg down. I don't believe in that. I think this is for the bulls now. I think it's always in long. But we're at a high of a range. We don't have a good breakout follow through except 10-11. So I would like to see bar 12 being a pullback and then resumption. I'll look at here as well, like we're creating a perfect zebra on the 50-minute chart, right? It's like a zoo. So high 1 triggered on the 50-minute chart, more bears above the bulls. We're probably going to get back to above the double top 5 and 7 and 8. But if you're scalping for that, you can do the same thing. So you might want to put your stop below 9, you can buy 18. If you put your stop below 11, you can buy 19, 25, 1950 for 1-to-1. But let's see if we get a more convincing pullback. Maybe just a daily range, so above 1, a good pullback. A good breakout above 1, but a pullback for a measured move up gives us much more potential. We know that the range is going to double. The bears are getting out break even. So if you sold the 9 close anyway, if you sold more at the high, 1950, 1975 was your break even point, and that just got reached. Was it? No, we reached 20. Okay. The 8 close bears, they got out break even. Well, the 9 close bears was dumb, so they don't deserve it. So 2025 was indeed break even, 9 close, 9 high. You sell the 9 close, you sell more at the 9 high, you get out break even exactly at that low. And there's a contract there between bulls and bears. If the bears want to get out break even at that price, bulls can do 2 things. They can either run up and force them out that way by taking a loss by going above 1. They can also just let the price go down there so that the bulls can buy on a discount and the bears are happy, right? What a good team. 2 opponents working together, driving the price down because bulls want to buy there, bears want to buy there as well. So let's just go down instead of up. So bulls might actually be selling towards the bear break even, knowing that there's a high chance that we're going to get there. Or bulls just buy a portion here. If they get the chance, they'll buy a second portion there. So disappointing close, this is going to be on the 15-minute chart, but we'll go again above the double top here. So bulls are scalping for another tick above the double top 5-8. Oh, they give it a rug to close the 15-minute bar nicely bullish. That's good. So some bulls will buy the low of 12, even with a stop below 11, which is a higher low, and then for the high of 5 and 8, and they got a 1-to-1. I think they even got a 2-to-1. But still, tight trading range. We're now at the high of the tight trading range. It's looking better on the 50-minute chart, but this is not a convincing breakout above the range yet. If anything, it's weak. Like you want to have a close around 45.26 for me to say measured move up 45.28. This is not that type of close. And so we'll just continue to watch the movie. But 12 was the close of the first hour. It closed as the tiniest bull doji that you can make. So a 1 tick, if you have to open up that 60-minute bar here and the close of that 60-minute bar here, there was 1 tick bullishness in there. So the bulls won the fight, but how happy are they with their victory, right? 1 hour would be 45.31, and a failure below 3 would get a measured move down, still to 45.02 area. I just want to see a short at these levels, or I want to see a long at the Wednesday low. That would be much easier than this sideways price action. Well, let's leave out the action on price action today, because it's just price. Now, if you have tight trading ranges like this, especially if they're going to last 20 bars or 30 bars, then typically the move out of a tight trading range like that is very explosive. Bears are scaling into shorts like a sponge, and bulls are doing the same. And one side quickly has to surrender and cover for the other side to get their measured move. So the longer a tight trading range lasts, especially if it lasts for 2 hours, 3 hours, the breakout can be very sudden. It can be it can be in 1 bar. So You're waiting for a breakout to happen for 2 hours, and then when the breakout finally happens, it's 1 bar and you miss it. This is not too long, like it's an hour of sideways. So it's not too long, but if this continues for 2 more hours, first of all of us will be sleeping because of boredom. But second of all, like that breakout can then be just very violent to one side or the other, and then you'll miss it as well. There are what I call sneaky breakouts as well. So like if 12 would have been a bull bar, that would have been a sneaky breakout. 10 is then the breakout to the tick. 11 is then a follow-through bear bar. 12 is then a follow-through bear bar. I think that's a sneaky breakout. You almost can't see it, but it's happening. And every next bar is going to close higher and higher, right? Now, by now, this is a failed breakout. So anyone buying up here is scrambling for their exit. Okay. 13 is a give-up bar. If you go below 10, bulls will want to try to scale in and get out. Bears will want to push through and get to 1075. Look at how that is a measured move from the 10 low to the 11 high. It doesn't mean anything. Like you'll find, if I have a hinge that we're going to go there, like you'll find measured moves that exactly line up to that target all the time. That doesn't mean any probability that we're actually going to go there. Well, good question. How do you define a good breakout? I think breakout will come in. We had a beautiful example this morning in the German market, the Germans, where, let's duplicate this. I think I have it here. Do I have this? So German market this morning, we had the same. So we opened here and we had sort of a wedge, and this was a sneaky breakout. It was a sneaky breakout from this low to that high, which was also a bear high on, sorry, this high, which was also a 50-minute higher low. It was the third leg from a wedge bottom. You can see what happens. You get a violent breakout, but it doesn't hit the measured move. So the breakout fails to hit the measured move. It comes down to the entry price. So if your stop is below 1 and you want to get to 941, you actually want to buy here at 907. Now the 10 bear bar goes down exactly to that entry price. Some buyers buy exactly the close of 10. Some will wait. Some will buy above 12, but they basically buy at the same level, and then it runs to 941. And we even got much, much more. But a breakout like that, even if it's almost at the target, it might still stall, come back, basically find the bulls that it missed, right? We had this breakout and a lot of bulls were on the sidelines. So it comes back to the entry price where the 1-to-1 makes sense. And then from there, it runs up to the target. That was beautiful this morning. Bulls will want to get back to the 12 close. The stop is at the 10 low, so it's a good price for them to buy. If they can get back to the 12 close, that's a 2-to-1. But you see that the moving average is flat. The 60-minute average is coming to the price. And so there's a tight range between the moving averages. That means sideways price action. Got a big down, we had a big up. Well, not even big. We had a down and we had an up, and we're now going sideways. We still have targets above and we have targets below. So we're burning some theta for the options, I guess, by going sideways. Let's take a look at 50-minute chart RTH. You can see that we're sort of in the middle of that range. So if the total range of the trading range is here, the middle is here, and we're circling around the middle of the range. So equal chance, equal probability of going to the upside as to the downside of the range. On the 60-minute chart, RTH, we have basically, I mean, you can argue head and shoulders, but this is not the context for a head and shoulders measured move down. This is a raging bull trend. And so thinking that we're going to do this is very opportunistic. But we'll probably want to test that 1525 again. All right, can we get then a breakout below 10? Or is it going to fail? Because there will be bulls here. But the bulls here are buying to get our break even. So 2025 or 1950. I think this could be the one successful breakout to the downside, but I'm not convinced yet. And you're still selling at the bottom of the trading range. Someone is saying my chart in NinjaTrader, I use the same NinjaTrader as you. My chart is not giving 81 bars, but it's giving probably then, what do you have, 86 or so bars? That is your trading hours template. So if you choose the CBOE US Futures RTH, you will get 81 bars. Tim, if we're in a very tight trading range, are you scalping, or you're scalping with limit orders? Do you still attempt to get 1-to-1 or 2-to-1? Yeah, always. Given this is a trading range, under what conditions would you scale in to avoid a loss instead of quickly exiting? If I know that we're going to go to some target, then I would want to scale in. So yesterday, chances were, first of all, chances were that there would be bulls below yesterday's low. Second, chances were that we were going to close inside the range of the day before. A close inside the range symbols a failed breakout. So if you, I didn't, but if you would buy the 21 close, I would definitely hold and scale in around here, because you know that we're going to, yeah, I mean, there's a high chance that we're going to close within yesterday's range in that sense, and we actually closed quite close to the high. So in that scenario, we definitely scale in. I have a strong target. I'm willing to scale in, but of course you have to think about scaling in. It has to be in your plan from the get-go. So if your maximum trading position is 3 contracts and your first entry is 3 contracts, you can't scale in. If you would do that at a desk, a risk manager would come, pick you up, and escort you out, right? Because you violated the terms of maximum risk. So 15 is a sell at the top for both the bulls and the bears. The bulls are break even, so they love to get out there. They bought more at the 10 low. They bought maybe the 10 close and the 11 close. They bought more and got out break even. The bears sell here because they said, we tried to go below the 10 low once. We're probably going to go below the 10 low again. If I put my stop around here, I've got this very nice looking 1-to-1 trades to 1725. So those prices confluence, and it sets up a deal between bears and bulls to sell there. Somebody's asking a very interesting question. Is there any correlation between DAX and the ES? I am a strong fighter against any type of correlation. So if you see ES, if you see the E-mini going up, why would you buy NASDAQ, right? So if you see NASDAQ going up, why would you buy an E-mini contract? Wouldn't you want to see the E-mini going up if you're buying the E-mini? So yes, there are divergent strategies, convergent strategies, like all kinds of things, but what do you do with it? And what do you do if it doesn't work, right? So you can't make a strategy. We cannot make a strategy based on that. I'm not saying that there are no algos and quants and people that have access to big data that can make a strategy off of that. But look at this. Let me pull this up. Look at this. Look at this. NASDAQ made a new high of the day. Okay, so bar 1 was a doji, right? Was not even a bear bar. So we're going to buy the ES because the Nasdaq has a doji? No. Like the Nasdaq has a little bit more strength. Well, there's 100 stocks that have, only some of them have something to do with the ES, right? And in the Nasdaq 100, 7 of them control, 75% of the Nasdaq? So I'm basically trading a basket of 7 stocks and a small basket of 93 other stocks. There's no relationship with that. There's banks and financials and whatever in the E-mini. The fact that I have a big bull bar on the Nasdaq, I cannot press buy on the E-mini. It works just as many times as it fails, and so you're basically gambling. And I have never seen any good come out of correlations. So if I think that the DAX is going up, I buy the DAX, right? Sort of the thing to do. Okay, this was a good short scalp. So I said 15 high, back to the 10 low. That's exactly what happened and what the bears took. Bears know, like, it's useless to hang on to a breakout because, by now, the chances of the breakout are slim. Chances of us staying in the range are bigger than the chance of us now breaking successfully out of the range. So they sold with the limit order, the 15 high, put their stop above 12, go back to the 10 low. Nice little scalp there. Okay. So now we have we have a starter and we have dessert. But we still need the 20-point swing. What is the average range round and about? I think it's pretty big at the moment, of course. It's about 44 points. Okay, not too bad. So the average range is about 44 points. That means on a trend day, the average range is going to be 60-ish, 70-ish. And on the trading range day, the range is going to be 30-ish. So if you say the range is going to be 30 points, then from the low, we should still go up to this level, or even higher. Or from the high, we should still go down to all the way here. So there's still going to be a range extension, either way or both ways, happening. Okay. Frustrating, obviously, that the biggest move happened before market open. Right, we tumbled from 45.40 to 45.16 pre-market, and then we're stuck with a 10-point range. Well, it's a very interesting question that is here. How do you define a good breakout from this range, right? Well, obviously 9 was a failed breakout. The easiest way to see a failed breakout is that the close is not even outside of the range where it tried to break out from. So 9 tried to break out below 5, and it didn't even close below 5. Okay. The second is, so here, what if we have this range? So we have the range from 4 to 6. 10 looks good, but 11 reverses. You can still come back here and get out break even. So even if you bet on the breakout, sometimes you can just, a lot of times you can actually get out break even if you're disappointed. Now, what does a good breakout look like? This, right? This is a good breakout above 53. So 53 is a lower high. 61, you're thinking, darn, like I wanted to have a close far above the 53 high. But this is a sneaky one because 62, 63 are closing with the stop below 60 and a measured move up that range. Let's see how we can get there. So we have the measured move is 45.2375. The stop is probably below 60. Like you don't want prices to come back below 60, right? And so after 64, you can still enter for a 1-to-1, which is the minimum you want in a breakout. So you buy the 63 close, or you buy during 64. When 64 goes above 63, you're still in the 1-to-1 range, betting on the breakout to succeed. If it doesn't, you usually get another chance to get out break even, and otherwise, yeah, you hit your stop. That is the thing with breakouts. But breakouts have directional probability that's bigger, like it's in the 60% range, right? The other way to look at it is, what would I feel if I was on the other side of this bar? Okay, well, what would I feel if I see 65 here? It's a big bear bar, but it's not a breakout. Like, it's not breaking out below anything. Like, you want it to break out below this bull bar because bulls are buying bull closes, and if a bear bar breaks out below those bull bars, all of the bulls are losing money. So they'll scramble to get out break even. So 65 here is not a bear breakout. It's probably on some time frame, but not on this time frame. All right, E-mini. You have a lot of people here that don't like what you're doing. Back and forth, back and forth. Someone asking, is it more accurate to trade RTH or ETH 5-minute chart? I would say RTH, because if you're in the stock market, you're selling stocks and buying stocks until bar 81, and you're buying stocks and selling stocks from bar 1. Like, what happens in the middle is not happening in your stocks portfolio. So I like it. I only trade any type of future if the underlying is open. And I don't need to trade the ES in European mornings because I have the DAX. So if you wake up in the middle of the night, you can trade India, you can trade Asia, you can trade Nikkei, you can trade Australia. Like, there's always, well, okay, weekend there, but there's always a liquid future market open that you can better trade than a closed market. Now, if I see the open, I'd like to compare the open to the 15-minute chart overnight. And that's because the moves on the open are typically at least 3 times bigger than the moves on the 5-minute chart. So it's better to compare the 5-minute RTH with the 15-minute ETH, right? The moves will be more equal in size than the 5-minute ETH and the 5-minute RTH. So it's looking better. Bulls are taking over after 1 failed attempt by the bears. 2 failed attempt by the bears, so they failed twice. And so bulls are trying to take over. But they are, I said, they want the 12 close, and they are at the 12 close. So can you buy here? Well, you can, but bulls are trying to exit here instead of trying to enter here. So it's, for me, too tricky, right? Look here on the 50-minute chart. Okay, so you sold this bear bar, this bear close. You sell more here, you get out, break even on your first, profitable on your second. If you buy this bull bar, you buy more at the low of that bull bar, you can get out, break even on your first, and make money on your second. You sell this bear bar, you sell more at the bull bar, you can get out, break even on your first, profitable on your second. You buy this bull bar, you buy more at the bear bar, you can get out, break even on your first, make money on your second. So what are the chances of this going higher instead of going back to the close of this bear bar, right? They're not that big. We're probably going to give the bears at least a chance to get out, break even, or profit. And that is the game that has been playing this whole morning. So they exit. Now we have the bears left that want to sell more and get back to the 15 close, which is 1925. And if bulls can break the 12 high, then we can go higher. So sometimes buying here is not good, but buying here is, right? Because chances of a successful breakout in this range are much higher than buying the 17 close, betting on a successful breakout. The trader's equation is totally different, and sometimes buying higher is better than buying lower, especially if you're waiting for the breakout. The breakout will come either way. So it's easier to wait for the breakout and then trade it at a lower price for a bear breakout or a higher price for a bull breakout. Can you place a stop order above 11? So you would place a stop order now here, betting on then a successful breakout to the upside. Well, if you'd done that earlier, you would place a stop order here above these double tops, and you would probably be disappointed in getting out here. So I would just wait. If there is a breakout, buy the breakout. But what if this goes 1 tick above 11 to trap you and then comes down 20 points? if there is a breakout, you want certainty on the breakout. So one more bar after 11. A breakout 9 that goes at least to a new low of the day. And then you can buy the breakout and you can save some gunpowder for a pullback. Like here, strong bull bar yesterday, possible breakout 63, 64. You buy the other half at 65, and then you can take it back off that other half when it comes down there, and then leave. Difficult to trade a market like this with one position, I have to say. So if you're a one contract trader, you're probably watching YouTube or something right now, waiting for a breakout. You set an alarm here, you set an alarm there, and then you see, find out what happens when we get there. At the moment, we're just destroying data for the daily options by going sideways. They lose a lot of their value. And we are looking at an expiry, so around 45.20. 45.20 is a very happy price, right? It's actually the close of one is a happier price than the open, if you look at how many times we tested that particular price. But you have to be disappointed that we didn't even go above yesterday's high. You have to be disappointed that we don't break out below the Globex low. So we have obvious targets, but we can't reach them. So it's disappointment throughout. But we will still double the range. I think we're waiting for Brad to come in an hour from now, and then he's going to present you with the biggest bull bar in the history of the E-mini. Very close now to the 15 close, the 1925 4 ticks. Now, if you find this, it's an excellent chance to get more. There we go. An excellent chance to get more points actually than the daily range. So it's 12 points range. If you took all of the scalps, you would be already on 30 points, just scalping back to these 50-minute closes. So that is, I think, in a tight trading range, for me, it's pretty much the only thing I want to do here. So sell here the 17 close, actually get out of longs, like scalp long back to the 12 close, scalp short at the 12 close back to the 15 close. Every multiple of 3 is a 50-minute close. It's been working the whole day. At some point, it stops working, but if you make 1 hour, 1 hour, 1 hour, 1 hour, 1 hour, and you lose 1 hour, you still got a lot of courses. Any advice for me just starting out? Yes, avoid this. Avoid tight trading ranges. If you're scalping here for point, you might have 6, 7 points now, and the breakout is going to be so awful that you'll start scaling in when that happens, just trying frantically to get out of break even. And you usually, at least that's my experience, personal experience, you usually lose more on that final thing than that you've been making here all morning. So if you're just starting out, yes, avoid this. All right, can the bears now step it up? They go below the bull bar. One of these ranges is going to be successful. 1075. So you would say 18 bar range. What are the chances that both the high, or that either the high or the low of the day is in? This is typically a 10% day, so we're going to see a new low and a new high most likely. This is not going to sell off into a big bear trend day. Yesterday's high was so close on the first test that we'll probably need to test it again. Makes me believe that this is probably a day where we're going to see a new low of the day and a new high of the day after bar 18. Well, the new low is in, and 1075 was still that target for the bears. It's trying to close within the range to indicate failed breakout, but it's closing far enough below 17 to make me wonder if we're going to get that measured move down, 1075. I'm not thinking this is going to get a daily range, that this is a daily range breakout. Because who's trapped, right? There's nobody trapped. Only the 17 bulls are trapped. These bulls are not trapped. They bought more, they're out. These bulls are not trapped. They bought more, they're out. So this is a trap for 1617. And so at most, we could get a measured move 1617. And that is the Wednesday low, which we already marked here. So it's not going to be a breakout that is going to go a measured move of the whole opening range. I don't think so. So just like the person that said, can we place a stop order somewhere here betting on the breakout? The same counts for, can we place a sell stop order here betting on a breakout to the downside? No, I don't think you can, because the odds are still that any breakout will fail. In this case, it might now be successful below 1617, but it's definitely not successful below 3, right? So the most we're looking at is the 1075. And so if you place a sell stop order here, 3 points, 8 points risk, not a very good trade. 25. And so if you place a sell stop order here, 3 points, 8 points risk, not a very good trade. We probably have to get back to the breakout point to find if there will be bears selling the breakout point for 1-to-1. We did go below that hour bar, so chances are that we're going below bar 3 again. So will the bears sell around this price? And will we then get continuation to the downside, or is this the failure on the downside leading to a success on the upside? Well, what would the bear do on the close of 20? Right? He would sell 20 to get out. So he would sell 20 to get out somewhere at 17, or he would sell here on the 18 high to get out. But as a bear, I would just get out on the site of bar 20 alone, right? Strong reversal down from the new low of the day. Measured moves to the upside. Yesterday's high there. Failed breakout. Is it too high to buy? Maybe, right? Maybe. There's probably some bears that want to get out break even first. So could be still a trap. And that's why I'd rather buy higher. Once we break the 18 high, we could get a nice move higher. So that would be 32.75. Bears are hoping 3 legs down, so we just have 1 leg, 12, 13, 14, reversal, 18, 19, 20, second leg, and they're now hoping for a third leg. But since we went up so far, the third leg will probably not go below 20. It will probably go below 1675. It will probably go below 16. Try to break out below, failure. Try to get there again. Bears giving up, second reversal up. That is the plan. Someone asking, is it worthwhile fading a trading range with limit orders at the top and sell limit orders at buy limit orders at the bottom? Well, there was a really interesting trading range earlier this week. Let me see, it's probably here. That if you would pull that strategy, you would probably not be very happy, because this was a trading range. Okay, trading range here, trading range low. So would I sell here with a limit order, betting that the trading range was going to continue? Well, I don't know how this panned out, but this was pretty devastating then for my short. So no, I will never just have a limit order at the top and have a buy limit order at the bottom, or vice versa, betting on a breakout or betting on a failure. I would want to see a breakout and then assume it's successful. If you want to know how a successful breakout looks like, this is one. So yeah, no, just blind limit orders. Better to look for a high 1 or high 2 or strong reversal, an actual setup, than putting resting limit orders on the sides. Because once in your life, you're going to have that CPI bar there, eliminating all of the 100 1-point scalps that you made in one 5-minute bar. Wedge bottom and upside, yeah, not really. I don't like the 9 not going below 3. So if there is a wedge bottom, it's still in the making, right? Even though 20 is there, it's still a bear trend. We're making lower lows and lower highs. Also, this was 2 legs down. So 20, it doesn't impress me much because it's not a breakout bar. It's a reversal to the middle of the trading range. If you buy it, you're buying the middle of the trading range while we just made a new low of the day. So 20 doesn't interest me at all in buying. Wicks on 15, 16, and 17, does that mean bears giving up easily? 15, 16, 17. Bears giving up easily. Well, this is probably, like the wicks here are probably indeed limit order bulls just buying at the 10 low, but they're scaling in to avoid a loss, or they never bought here in the first place and they just buy here to join the bulls that are scaling in to avoid a loss. I think that's much more what it is. But the tails indicate on lower time frames a trading range. So this bar 15 is definitely a trading range on the 10-second chart. It went up, it went down, and it closed in the middle. Definitely a micro version of what we're seeing all of this price action this morning. So it's not weird that on a lower level, the same type of things are happening as on this level. So if this continues for a long time, then the 5-minute chart is not only in a trading range, but the 50-minute chart is also in a trading range. And so you can see that, like the 50-minute chart is creating zebras, like that is in a trading range. And so if you see the 5-minute being in a trading range, you see lots of 5-minute bars being in a trading range as well. And that is a trading range on the 1-minute chart or on the 10-second chart. So you had here bar 9 was a trading range on the 1-minute chart. And then when we went above bar 9, we actually got a measured move on up after a breakout on that time frame. So this was a trading range on the time frame. There was a breakout and a measured move up on that same time frame. But how do you trade it, right? You don't trade it on this chart. You trade it on that chart. So if that's a 10-second chart, good luck. Do you pay much attention to wedges in these trading ranges? Well, I pay much attention to 3-legged moves. So if this would be leg 2, if this would be leg 1, then this could be leg 2, and then this could be leg 3. So if we would now drop here, this would be a buying opportunity, like a high 2 or whatever, and this would probably be a bull trap. We could get a 3rd leg down to this range. I don't see this as the 2nd leg and then this as the 3rd leg, because I'm looking for legs that are sort of the same size. And I think 1 and 3, so bars 1 to 3 were 1 leg, and bars 12 to 20 to the 20 low was a complex 2nd leg. We could get a 3rd leg. Are there 2 Tims that host this trading room? Just curious. Yeah, man. We cover all of the time zones. I think Tim Fairweather, he trades at midnight or something, like in a very weird time zone. So yeah, much respect for him. He has a whole day and then he trades. I just wake up and trade at 9 in the morning, the German index. Out here either in Amsterdam or from Barcelona. So my index opens at 9. I'm usually done by 11:30, and then I have a nice little break, and then 3:30 opens the E-mini. So yes, I am a Dutch Tim, the bad one. Okay, so that question is answered. Yes, there are 2 of us. I typically like to trade 30 bars or so. When I'm taking full risk, so in the trade, when I'm presenting in the trading room, I typically don't take full risk. I typically trade like a quarter size. When I'm trading full risk, like risk on, then I get so I look at price so intensely that after 30 bars or so, I have to give up just because of fatigue. Decision fatigue is a real thing. So like you can only make so many decisions on a day before you start making the wrong ones. Plus, like I have a life as well, so I like to get out at around bar 30, which is roughly 6 p.m. So I do 9 to 11 p.m. I do 3:30 to 6 p.m. and that should pay for everything. Sometimes I'm stuck, especially on Friday. Sometimes I'm stuck. You're stuck in a trade. Like yesterday, when you think it's going here, you have to sit, in my case, until 10 p.m. to get to that target. So lowering the risk and then just set what I call an OCO order. One cancels the other. So you just set your profit target, you set your stop, and then during dinner, one of them will get hit. That is a strategy, but sometimes, yeah, no, I just I make my living from the DAX and not so much from the US. Also easier to just earn it in the currency where you spend it. I missed where you set your target to upside on the 5-minute. Is that a measured move or a previous level? So that would be a measured move. So the stop for the bears would now be here, right? Lower high. And so a breakout would take us to 32.75. So we will get a breakout, we'll get a little pullback, and then we will get 32.75. Scaling in, I answered that. Thank you, Tim. Would you please elaborate on the arguments for the visit of the Wednesday low? Failed breakout. So if there is a failed breakout, where can I see it? So you see it here, right? So we're trying to break out above 22 high. We fail. On 35, we're trying to break out above that bar again. We even try it 3 times and then it works. But the first instance is a failed breakout, and there's a high chance of us testing that breakout level again. When does it end? Well, if we go above yesterday's high, then we're not going to see the Wednesday low. And they tried it on 20, and they got so disappointed that we might not make it to the Wednesday low. I think 20 changed something in the market, right? You saw how violent it reversed back up. So bears are using this bar. Look at here. Bears are using this bar. They sold here on the 60 low. They sold the 70 low. Bears are using the 22 low to get out of their shorts. Bulls know that. So when when 21 and 22 are a pullback from the long, they'll buy above 22 for a measured move up to 21.75, and they got it, right? So we're now here. Can they get more, or is this it? It's also the close of bar 17. It could already be everything that the bulls wanted. They have a measured move above the pullback. What time does the Frankfurt exchange close? 5:30 p.m. But there's no way that I'm going to trade for 8.5 hours. I like to just get in and out quickly. Hour or 2, 3. What a lovely life if you can just make your do your work for about 3 hours, the work that you love for about 3 hours, and then have so much time to enjoy all of the fabulous things in life as well. That is my philosophy. This is cruel, this range. I knew I should have given the morning shift to Brad. Yay. It's still a final flag, eh? So if you're looking at here the sell-off right before the open, then this is just still a final flag. So chances are still that we're going to go lower and form some type of a wedge before reversing up. But it's just not doing anything. Yeah, that's right. I get a lot of feedback from what I just said. The motto that I used for the longest time is do what you have to do until you can do what you want to do. And so if it is 2 jobs, or if it is trading at the evening and working during the day, or if it is just trading one boring setup only, well, if that is what works, then that is what you have to do. So do what you have to do, and then you can later do what you want to do. It's still my motto. So what time does the Frankfurt exchange close? Well, actually now. So 3 minutes from now, Frankfurt is closing. We have some after like market close price action, but the stock market is closing in 2 minutes. That explains often why the first 2 hours can be sideways, or that the first trend can be 2 hours. Like Europe is closing down, so some of the rotations between Europe and the U.S., like selling stocks in the U.S. and buying them in Europe, or selling them in Europe and buying them in the U.S., that all needs to be done before now. So sometimes it takes 2 hours of sideways, and that might be the reason. Like, you never know what the reason is. You shouldn't care about what the reason is. But we can look at it now. So this was the DAX this morning. You can see 105 bars on a day, $25 a point. So about 2 times larger than an E-mini contract, but doing the nicest measured moves on the planet, just like the E-mini basically, right? Measured move to here, 3 legs up, 1, 2, 3. A little hesitation there at the top. 16,000, big round number that we of course don't get to in the first attempt, but we will next week. And then breakout to the downside, measured move from that low, ultimately didn't reach it. So bear stock, sideways, same type of sideways here since I think, so this is the time where the mini opens, bar 78. So just sideways here, like it's going sideways here. But already started going sideways much longer, and we're closing the week, so the bulls on this chart are actually concerned with the price on the week. Now, today that doesn't make any difference because it's a big bull bar. Bulls want to close the week on its high. Well, they're closing it almost on its high, 30 points, 20 points below the high. So next week will be higher on the DAX, and we'll probably see 16,000. But that's now closing, so that's now in post-market. Right, so can we get some action now here? Now it looks like nothing was really easy this morning. Oil. Oh, this is weekly. Wait. Oil was better. So nice bull trend here, but look at the sell-off from the day before. Big sell-off. Sell it close, sell it close, sell it close. And this is now at about 50%. So nice bull trend. High one, high one, high one. So there was much more to do on oil, but didn't see it. The what is it? The Russell had a 6% day this week after the CPI, so an absolute dynamite move up. I think you can see, and that typically happens on inflation data because it hits the smaller and mid cap much more favorable than large enterprise. large enterprises operating in a lot of different currencies anyway. So an index like Russell is way more sensitive to us not getting a lot more interest rate hikes, and so it absolutely rocketed to the upside earlier this week. So this is Russell, 5-minute chart, double bottom, almost double bottom, new high, 3 legs, if you will, or 2 legs, and now breaking to the downside. But look on the daily chart. Why is this not working? Pull it up here. Absolute super huge gap up, super large bull bar, trying to break above these lower highs, but not doing enough. But on the weekly chart, an enormous bull bar, creating a big reversal up, probably going to these gaps, probably even going to these gaps. So this was much more sideways. Russell went much more sideways when the E-mini went down. So this is much more a failed breakout at the low of the trading range, leading to a test of the high of the trading range. We could actually go to 2098, like these levels. So much more action on the Russell this week than on the E-mini. But doesn't matter. We'll get the breakout someday. Somewhere today, it's going to break out. Still think we'll have to see the high of yesterday, but there's no urgency. Inside bar on the 50-minute chart, so probably more buyers below than sellers below. Interesting question. Where and how did you develop such a belief in measured moves? Well, here on the charts. Took me a while. I'm not gonna lie about that, but I found out maybe a couple of things along the way. Trading oil, I traded oil for a long time. Realized that bulls are buying the close and not so much above bars. Like for the measurements, they buy the close, and ranges are typically more reliable. So a range to the downside is typically more reliable from a bull bar, and a range to the upside is typically more reliable from a bear bar high. So a measured move here, I would measure that bear high to there, because this is the stop. So you want to smoke out the bears that have their stop there. Some bears will scale in. You want to smoke them out too, and then you'll get a measured move up. So as soon as I started my training on measured moves, I discovered all of these different measured moves that there are, and then I tried to take them from the higher time frames to get better trades out of them on the 5-minute chart. And then you'll also find out what happens if the measured move fails. So measured moves here, if that fails to 2 ticks or 3 ticks, it's probably going to come down all the way into the original range. And so it's just a matter of like every day watching. Okay, I saw that move, I saw that range, I saw that range. Now, if I see every day some type of a range, and I learn to trade it, I'm already making money, right? Especially if I can then circumvent some 2-to-1 type of risk reward around it. If you think about 2-to-1, you only need, like if you are 50% correct on 2-to-1 trades, you're already making money, right? That's the essence of why you want bigger reward than risk. Basically, I always see bigger reward than risk as margin for future losses, right? So you win 2 times more than you lose. Well, that means that you can now lose twice and still be happy. And then if you do that over and over again, you'll actually take out more 2-to-1s, or 3-to-1s, or 4-to-1s, like whatever is your thing. But holding for targets, not in this range, not in the tight trading range, but holding for larger targets, when you start to get trust in measured moves, it just makes your life a lot easier, and it will build on itself. So as soon as you've done it like 10 times in a row, you will connect the dots in your brain. You will actually make the right type of neural connections to now start holding that longer and better for the right type of measured moves. So Usually on the open, there is some sort of a measured move. In this case, it already went before the open, but here you go, like breakout below that bull stop. Well, the measured moves to the downside of the bull stop. So expect a measured move here. Okay, and there we go. So I would actually look to sell. If you're at the moving average, it's a low too short, and your measured move target is there. So great risk reward. You can just take actual risk and then run it all the way down. But it takes a while to find indeed the targets first, and then I changed my approach to finding the stop and finding the targets, and then look to see what happens around what the entry price will be. Well, if there's a high 2 at the entry price where I was expecting bulls to step in, it's just a dynamite trade, right? And you hold it to the target. Range is getting smaller. So what happened after bar 20? Disappointment, disappointment, bulls out. What happened after the biggest bear bar of the day, 19? Well, we got the biggest bull bar of the day. So everybody now knows what's going on, and one side still needs to overpower the other side. This sell-off is what sits us in the way, right? So this was a 30-point sell-off, and so we need to overcome that. That's not going to come from here. It's not going to come from here. It's going to come from maybe here. But bulls are scaling in at lower levels, trying to get back to 45.30, 45.32 area. But them scaling in also means that they're scaling part out, right? They buy this and they scale out this because they bought 11 or 10 first. Now they buy 20. They scale out part at the 10 close because they're not confident that we'll actually go in one way up to yesterday's high. And so we're just moving on, 45.18, 45.17, 45.18. Can you show an example of a low 1, low 2, or high 1, high 2? Sure. Here. So 70 from yesterday. That's a high 2. So you have a pullback. It goes above 68. That is the trigger of the high 1. There's more bears there than bulls. We get a second try up, so that 70 triggers a high 2, and then it rolls up to the upside. Okay, we get a breakout above this bear bar all the way there. Well, not at the close of yesterday, but you got it at the open of today, which counts. So high 2 ultimately leading to, in this case, just you would get out at the close. Low 2 probably below 49 was a low 1. It didn't trigger, but then it reversed back up and then came down again. So below 51 was the low 2. So low 2, low 1. It didn't trigger, but that doesn't matter. It's still a two-legged pullback. If it triggers the low 1, the high 1, or not, doesn't matter. Right? You're looking for basically an ABC pattern. So down, up, down. That's a ABC pattern. High 1 failed, high 2, or high 1 and high 2, but the high 2 is at a better price than the high 1, and that's suspicious. So you should always, if you exchange more information and you get in return a better price, that's suspicious. Okay? Because the aggressive bulls that buy the first time, they should be rewarded for their aggression by being able to enter at a better price than the bulls that wait for a second confirmation. They should get a worse price. Still glued against the moving average. We are at the second hour just closed. Let's take a look at that. So second hour closed as a bear bar, large tail. Didn't take out this low, so we're technically still bullish on the 60-minute chart. We're technically bearish on the 50-minute chart. So the measured move I would see now is this one, right, to the downside. The measured move I would see now to the upside would be this one, to 45.32. Those are the two that seem most likely to me. I don't like measured moves on the 60-minute chart, simply because it can take 10, 20 bars on the chart to get to a measured move target. And so if you take that from an hourly chart, it could take 20 hours or 10 hours to get to that target, which is just difficult for intraday trading. But if we get a huge breakout, then all of the targets on the 5-minute chart or all of the measured moves on the 50-minute chart become obsolete. And you just need to look at something bigger. So CPI this week, you look at the hourly chart and you immediately see where the measured move goes to when you see this breakout, because it's going to be this whole range to the upside. So from here to here most likely, and that's where the gap after CPI from this week ended. No, after the first hour we ended at that measured move. So you always have to ask yourself, what is breaking out of what? So yesterday 65, that's not a breakout, that's a pullback in a small pullback bull trend. A small pullback bull trend will usually go to the lower third. Right? And why is it doing that? Well, it sets up a 2-to-1 long entry. So in a small pullback bull trend, you get a pullback to the lower third, you buy it, you put your stop here, it's going to go back most likely to that previous bull close. So small pullback bull trends, you get lots and lots of 2R type profit trades. Nice looking bull bar. They want 45.2150. Where is that? That's here. But it's still just sideways and sideways and more sideways. Here's what I mean. Like, you have a lower high on a micro scale. We try to break above it and we fail because we close in the range. So the bar after it is trying to break above it again and might now succeed or it might fail. But if you can find a trade in that way, knowing that it will go to 20 again, you can buy 1825, stop below 27 and see if it can go up there again. That's tiny little scalps that, with the 1R, you can play with size, of course, like 2 points risk. Maybe you can do larger size than a 10 points risk trade, right? And that still results in the same type of profit. Someone's asking, can you not consider 65 to break out below the 63 low? Yeah, but 63 low is just a leg. So this is one leg, bull bar, bull bar, bull bar by the close, all the way up. And so this is not breaking, like this is not a range. The range on the 5-minute chart was this, 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 and this. So if it would break up below here, big, then I would see a breakout, and then I would see a range going to 4,500. But this is not breaking out below anything on this chart. Like on a lower time frame chart, it's a breakout, but on this chart, it's just a big pullback that I immediately would want to buy the close of. So if I see this, I buy the close of 65, and I'm already very happy if I see 66, and then the follow through high 2 above 70. Going all the way back to the high of the day. And remember, we established this measured move to 22.75 already earlier in the day. So I'm still trading here towards that target. So I buy 65 and I'm very happy that I get the chance to buy, because you can see a second later, it's gone, right? 1 bar later, we're already back 4 points higher. 1 bar later, we're already back 4 points higher. Okay, so we did that. So we hit the 24 high. It's getting more bullish, but it's so slow, painfully slow. So you can also do a horizontal comparison. So we had a low on bar 3, we had a low on bar 20. So there's 13 bars in between. So you can expect, if there is a new low, to expect it around bar 33, because wedges often have symmetry. At least between 2 legs, they'll have symmetry. But I would not be surprised if we now get a quick down and then up, just for, well, could take a couple of more legs, but 3, 20, 33, 34, or 30 and then a reversal up to a new high of the day. That could be a scenario. I honestly can't remember a day that I was presenting that it was so sideways. But yeah, it's also a gap close festival, so there's not a lot of gaps though. So in the first 10 bars, no bar left a gap. There was a gap to the 9 high, and there was a gap to the 18 low from here. But there's no gaps at the moment, and there were no gaps yesterday, so not a lot of gaps that have magnetic effect. Someone's asking, when you get out of shorts in the morning, what do you do then? Well, I put on pants, right? Out of shorts, put on pants. Someone's asking, is it beer o'clock? This market is putting me to sleep. Well, it's Friday, 6 p.m. here. Almost, just saying. See, should the upper tail on 1 be a concern for stop order entry about 11:12? Well, the upper tail on 1, so on bar 1, if bar 1 is big, bar 1 is always running to a magnet immediately. And so if I see bar 1, sometimes you see a big bull bar or a big bear bar. Well, you have to assume that you're already at the magnet when that bar closes. So usually, if you have a big bar at the open, there's not much more left to the trade because you're at the target where the trade was going to. And so I said that 65, for me, a break above a big bear bar sets up a measured move up. And so the bar 1 opened and it raised up to that 2550 target. It went down. It went up to that 2550 target again, giving bulls a second chance to get out, and then it started to come down. So the tail for me is no longer a concern because it was the measured move from yesterday. And that happens a lot at the open, where stuff just runs to a target. Here, failed breakout above a lower high, and then reversal. Quick run to a target. So what target was this? Was probably a target from here to here, right? Met at the open, and then bears start to sell. So a lot of times a big bull bar on the open is actually a bar where bulls get out instead of a bar where bulls get in. You can see it here as well. A magnet to a measured move down. What's the measured move? Well, it could be this one, or it could be the 70 that we ultimately missed, but it was probably the 71 on the 50-minute chart. Bar 1 just races to the measured move target and then stops there and reverts back. So if I see a big bear bar here after a big gap down, I think it's more of a climax than it's a start of a bear trend. I like a small bear bar and another one, like a nice bear trend from the open. Big climax bars on the open are typically just vacuums to a resistance, and you might have to wonder what's left of the trade directly after bar 1, 2, or 3. All right, that was the questions on the Discord, and then the questions here. You mentioned DAX and E-mini futures are great. Any good futures for China, India time zone? Yeah, I think Nifty 50 or Nifty in India is very good. High volume, super high volume. Very good price action. Nikkei, even the ASX in Australia is a good future to trade. But yeah, learn your instrument first. But no, there's absolutely like Nifty is opening at 4 in the morning my time, 4:45 I think my time. But if you're in Asia, it's absolutely good to look. All right. Yeah. DAX. How long does it take to be a profitable trader? Well, you decide. For some, it never comes, huh? So you've got to take that into account as well. But it takes a lot of time, and it takes a rewiring of your brain for sure, right? As soon as you start holding I said at the beginning, there's another question about that. There's three things that you can control as a trader: your entry, your stop, and your target. And every trader that is not profitable at the moment will probably only need to change one of them to get to the side of profitable. So either your stop is not okay, or your entry is just weird, right? You buy 11, well, you're just hoping for a breakout, but most breakouts fail, so we're going down. So you're not buying 11. You're trying to see what happens after 11. So your entries are not okay. But by far, for most traders, their exits are way too early, right? And that comes to yesterday's bar 65. A lot of people will exit their trade, or they will get spooked out and they will take a small profit or get out break even, while there is from here 12 points to be made with a stop below 61. Absolute dynamite killer trade. Like to the close, if you buy the 65, you get what? 4 times risk reward. So you need those profits. You need those profits to offset the losers. Also, a lot of traders will think that they will go from not being profitable to being profitable, which is of course not true. You're going to get less losing days and more winning days, but it's still gradually shifting as you're trying to eliminate mistakes, as you're trying to just do what you need to do. You'll still be making mistakes. We'll probably make a mistake every day, but you're trying to eliminate those because you know that dumb stuff hurts your profitability. But look at your profitability as a moving average. Over the course of time, you should be getting better. And then comes into play if you do what you have to do until you can do what you want to do. If you're very good in one setup, high twos or breakup pullbacks or whatever it is, just do that. Like just rack up whatever you want doing just that setup. And then as you're looking at the screen anyway, you'll become like mentally proficient in the other setups and you can add it to your repertoire. But I mean, if I would know a trick to make a lot of money, then I would milk the trick, right? And so that means that if you're a high two, low two trader, that on a day like this, you're probably studying, right? Can you show an example? When looking at high twos and low twos, do you look at wicks or the body only? So high two is a breakout above the high of the prior bar, right? So you look at the wick as well. It's a tiny little range that you then want to break out of. Can you count legs in this trading range for us? Yeah, it depends on if you want to see the big legs or the small legs. So the big leg was definitely leg 1 equals leg 2 for the bears. But in here is leg 1, pullback leg 2. So in that second leg, the first leg was 1 leg, but the second leg down was actually on this time frame 2 legs down, but it's still a second leg down from the first leg, but just divided into 2 legs here. These were 3 legs, so 4 is a leg, 5 is a leg, 6 is a leg, so it's a wedge on some lower time frame. Then you have 2 legs here, 8 and 9. So you have a leg down, pullback, 9. And then you have 2 legs up, 10, pullback, 11. Then you have all of the shenanigans here to create the 2 legs down. And then now we're at leg 1, pullback, leg 2, pullback to 29. 30 is the third leg up from 20. It's starting to look better, so I'm thinking we should be able to get to 23, 25. And the breakup might come from 2 ways. So sometimes when the bulls get to the high of the range, they are already so tired that they need to rest a little. And if price then stays right below the breakout point, that is a good indication that the bears cannot get it down, and so that the bulls can try again for a final breakout. But if it comes all the way from the low in like a buy the close bull trend, by the time you're at the breakout point, bulls are already exhausted, their stop is too far away, and you're not going to get the breakout. If it then starts to like hang just below the high of there, then you could get a breakout. It's mostly known as a cup and handle pattern, but a cup is like initial breakout, gathering strength, cooling down some of the indicators if you use those, and then you get the final breakout. So I'm not counting on this to break above the one high and then get follow through. We just might get a touch first, and then some sideways, and then the upside breakout. So pairs reached that 11 close, bulls reached that 11 close, and now we're going for the one high. And they call this the trading room presenter phenomenon, where as soon as the presenter of the trading room leaves, you're going to get the breakout. And so time for me is up, and that means that the breakout is imminent. First target, 32.75. Second target, 39.25 and around Globex high. All right. What setup is your favorite? Breakout pullbacks. Love those because of the high probability. You know that you know where we're going. High probability of getting there, and then buy the pullback. All right, I'm gonna close my session. Brad is gonna come in and take you guys straight into the weekend. And for me, that is starting exactly now. So thanks for your attention, everyone. I will be back somewhere later this month. Have a great weekend. Catch you on the other side. And for those that have it, have a wonderful Thanksgiving. And I see you on the other side. Thank you. Cheers, guys. Bye-bye.
Bulls are trying to get the upside breakout. We've been in a tight trading range, so chances are it's basically a breakout mode pattern. Tight trading ranges, they lead to measured moves. I want to say one thing about what Tim was saying. It's really important for traders to focus on swing trading. And a few things Tim just mentioned that really caught my eye was a lot of traders, they end up, the reason why Tim's saying that it's so important to hold on to moves is it forces you to swing. That way, if you mess up or if your probability is not that high or not as high as it could be, when you're scalping, you're trading with limit orders going back and forth, your risk reward is always bad. But if you're swing trading, you're buying above 20, stop below, and maybe you hold, or maybe you buy above 30, stop below, and you give it a chance to actually break to the upside, you're greatly improving your probability overall. And the reason you're improving your probability overall is because your risk reward is increasing. That way, if you do have a probability of 50% and your risk reward is 2, you're going to do really well. And that's why I just wanted to mention that. He said that it's easy for traders to cut their wins too early. And that's one thing I like hearing about what Tim has to say. And I know Rose talks about it as well, but setting targets, buying above or 3 consecutive bull bars, don't be afraid to go for a measured move. Or if you're long, maybe you put a stop a couple of points below a bar and you trail. I'm going to turn the screen off and I'm going to add the pointer. And high ones are it's pretty common for a high one setup to trigger the high one, which we did during the Globex, pull back to around 50% in a strong trend, and then try and resume the high one. And the reason that happens is this right here. Let's just go to the Globex really quick. So here's the Globex on a 15-minute chart. Yesterday was the 16th. And pretty much the high one, the high of the day was somewhere in here. And you can see we went above it during the Globex, sold off, and now we're trying to get the upside breakout. I don't think we're going to go far. We might. But the reason I bring that up is yesterday's high 26.25. That increases the probability that we're going to try and go above this blue line. Are we always in long? I think we are. It's always in long, strong enough breakout, probably a second leg is likely. But what do you notice? You see the left bar 11, you see the left bar 1. We're at the top of a trading range. The bulls have momentum. They're doing a good job. But if they really need to continue, they need to continue the buying. If the market starts to stall, you'll have traders reduce their position. A lot of traders like to, it's easier to see, a lot of traders, they're willing to buy as the market's breaking out. They buy above 30, maybe they add on 31, 32. But if they don't see a strong breakout, what do? They start reducing their position. So traders are happy with buying as long as the market is continuing to go higher. By the way, I did fix my TradeStation. For those of you that have TradeStation running slowly, I called support. They told me to close the application, right-click on TradeStation, run as administrator. When you run as administrator, you'll be prompted to it'll log you back into TradeStation. Then you go to File, Preferences, Desktop, but you have to be in Run as Administrator. And then, actually, you may not have to pick Run as Administrator. You can do it right here. Anyways, I went to Run as Administrator, File, Desktop. I clicked on Performance, and I changed it to Auto Configure for High Performance by TradeStation, and that seemed to fix the issue on the other computer. But, and again, I just called support on that one. So we're starting to pull back here, and that's a little bit of a warning that this breakout is not as strong as it could be. We have a tail on 31, tail on 32, and that's disappointing, and that's a reminder to traders that something is not quite right. So a tail, disappointment. Is that a reason for traders to start selling? I would not. It's not always in short. Strong enough rally will probably get at least a small second leg up. But this is also one thing Tim mentioned. So let's remove some of this right here. If you're buying right here, you're buying high in the trading range, and Tim talked about that. That could be it's the same danger here. The good thing for the bulls is we're breaking out above all the bars to the left. And I say that we're breaking out of a lot of bars to the left. And that will increase the probability that the market will go higher. The bad thing for the bulls is we're hesitating at important resistance, the high of bar 1 and yesterday's high right here. That is not what I wanted to do. So here is yesterday's high. Feel free to ask questions. I will review them here shortly. I'm going to remove the high of 1 because it's basically the same price as yesterday's high. So this is what the bulls are trying to accomplish. Inside bar, they want strong follow through and a test up to the September 1st high. Will they get it? They might. This bar today is important though. The stronger today is, the greater the chances that we will go higher. We will go higher. But we're still in a large trading range all through here. If we start to get strong bull closes, that will increase the probability that the market will go higher. So always in long, okay to be long, maybe stop below, a couple points below 32. Technically the stop's all the way down here below 30, but most traders are not going to let that stop get hit. And if the market starts to stall or go sideways, more and more traders will consider exiting. Callan in Discord said, Al said yesterday, if you buy at the top of the trading range hoping for a breakout and measured move, get out below a large bar or 5 points below a previous bar. Yeah, what Al's saying is, here's an example. You're long, in here, it never looks all that great, overlapping bars, but you're getting bull closes, so it's always in long. And the problem is, you look to the left and you know you're in a trading range. So at any moment, this could be a lower high and a sell-off. And the reason why Al says get out below a bear bar closing on its low, or 5 points below a bear bar, the point is really dependent upon the range of the bars. But traders get out a couple of points below because you can get something like this, and then it just starts to sell off and go sideways. And that's kind of the risk that the bulls face here. I'm still long a partial position, but I'll get out a couple of points below 32. Why 32? I want to give the market space in case it keeps going up, but at the same time, I want the market to break out, and if it starts to stall, I'd rather get out of the trade and then reassess. Someone asked where we'll add on. Depends on how this closes. We're getting strong bull bars, and that's good, but I really want to see breakouts above all these bars. So here, top of the channel. I do think there's sellers not far above. I say that. I think we're going to go sideways above here. However, probably the first will, let me back up. I think we're going to go sideways, but I do think the first reversal down will most likely fail. What do you do if 34 closes on its low? If 34 closes on its low, I'm going to fix some. If 34 closes on its low, it's okay to get out and then wait to buy again above a bull bar. Or you can just use a stop, maybe a measured move down on 34, betting that the bears won't make a minimum scalp. I'm going to fix something on this bar counter because it's showing bars 1 and 2 and then not 3. And it just looks a little strange. There we go. It was showing bar 1 and 2, and then a pause, and then 4 and 5, pause. I really want it to I want it to be in increments of 3. So bar 1, no bar, counter on 2, and then 3, none on 4. I guess it's every few bars, but that should fix it. Probably buyers not far below, but not really what a lot of traders want to see. So if this bar closes as a bear bar closing on its low, I suspect a lot of bulls will be interested in just scalping out or exiting rather quickly. Traders buying below 33. I'm going to load the encyclopedia. When the market's in a strong trend, traders are happy to add to positions, hold through pullbacks. But when the market's in a trading range, everyone gets a little more nervous about holding on to trades. And the reason is, for obvious reasons, you can get deeper pullbacks than what traders really want to face. I've got one more thing loading, and I'll turn the screen back on. Traders will pay close attention to how this breakout appears. If this bar closes on its low, that might force more traders to exit. And again, I know the chart's off. I'm going to open it. I'll turn it back on here in just a second. Not what you want to see if you're a bull. The bulls, they're hopeful this is a breakout pullback, test of these breakout points, and a reversal up. However, 35, if it turns up, it'll be a high 1. And there's an added risk that there's probably sellers not far above the high 1. So the appearance of this bar is important. So the appearance of this bar is important. If 35 closes as a bear bar closing on its low, that will increase the probability that we get a small second leg down. I bought more down here, but I'm disappointed. And depending on how what this bar does here in the next few seconds, I will probably just exit the trade. You can see there's not a lot of energy by the bulls. We're not racing down, but we're not rallying all that quickly. And that's a warning that traders are not just eager to buy this price. Everyone's concerned that the market may end up going a little bit lower. This is what I was talking about. This is the concern for the bulls. The bulls should not have allowed the market to have this deep of a pullback. That's why a lot of traders will get out below bear bar or a couple of points below, or as this bar starts to go down, it didn't race back up, so a lot of traders started to exit. My only problem with selling right here is you're selling low you're selling right back in the range, but there's also probably bears buying back shorts here and bulls buying. Because of the consecutive bull bars, we'll probably get at least a small second leg down. But I think it's better, as far as selling goes, to wait and see what this bar looks like. You're right at the moving average. Big up, big down, probably sideways and not straight down. These tails were problems for the bulls. So what are the chances that we've seen the high today? We very well may have seen the high today, depending on how this bar closes. Right now, we're becoming always in short, and we're trying to close below the moving average. Two good bear bars, 34, 35, but let's see what 36 looks like. What are the chances? 37's a big bear bar. I think we'll probably have to pull back first, but this is a strong enough sell-off. We'll probably get a second leg down, likely, and that will reduce the amount of traders buying here. There's probably sellers above this bar. Do you want to sell the close of a bar with a big tail? Probably not, but there's likely sellers not far above. So tail on 36, that's good for the bulls, increases the odds that we may pull back, but the bulls have to overcome these three big bear bars, and that will be a problem for the bulls. It increases the probability that we're going to get a second leg down. So probably sellers above scaling in higher for a second leg down. And the bulls, they need at least a micro double bottom. The bulls need to undo this damage. So why not sell at the market right here? Some traders might if they can scale in. I think the challenge for the bears right here is risk reward. So if you're selling at the market, your risk is here, stops up here. Probability is, I don't know if it's 60%, we're going to go straight down. And a lot of traders, they'd rather sell a pullback to improve the risk reward. Trading range days are always trying to get you to sell too low and buy too high. Leg one, pullback, second leg trap, three big bear bars, and instead of going straight down, it may pause, pull back, and then get a second leg down. Three big bear bars, deep pullback, second leg. So that is the problem that the bears are facing. The bears are hopeful that this is a wedge. 1, 2, 3. And then we get 2 legs down, maybe a test of today's low. Why am I not more bullish? These 3 bear bars. And we've been in a bull channel for some time. So spike, pullback, channel. And because we're in a channel, we'll probably start to evolve into a trading range. And obviously we're already in a trading range. Bottom of the channel was here. We may have to sell off all the way down here over the next couple of days. But at the moment, probably a second leg down likely. The bears, they want something like this, 3 big bull bars, test of the highs, big sell-off, and then they want a second leg up. But again, my problem here is I think there's sellers above, and I think there's buyers not far below. So chances are we're probably going to go sideways. Bulls, they want to trap the bears. But after these 3 bear bars, I suspect we'll get at least a small second leg down, and therefore we probably will not go straight up. Is this the start of a successful reversal up? Nah, probably not. I think it's just a pullback that's going to lead to a second leg down. Targets for the bears, the low of 30, the low of 25. Any one of these can be targets. Traders will pay close attention to how deep the pullback is. Targets. Traders will pay close attention to how deep the pullback is. It's really common in trading ranges to fall below obvious support, such as the 30 low, big bull bar, start of a breakout. We could easily fall below it. You can see with all this trading range price action we had, it's really difficult for the market to break far above it, and it ends up getting vacuumed back to the middle. So we had a triangle, we broke above it, and we failed. What about buying on a stop 1 tick above the high of 34? I would not. Bulls, at a minimum, they need to start getting strong closes. You know, they need to get something stronger than bars like 4, 5, and 6. Otherwise, probably just sellers above, second leg down. I sold above 36, and I'm willing to scale in. The rally up to 33 is strong enough for a second leg, but this sell-off is probably going to get a second leg down first. It's pretty common. You know, the reality is if you trade breakouts and you take reasonable trades, even if you buy high, you see this all the time. If you buy the close of 33 and you put a stop, just say a measured move down of this, so you just put a stop way down here. If you buy, scale in, you know, one or two times, usually the market will allow you out near break even. In other words, it'll bounce enough to allow traders out. Low 1 short on 38, probably buyers not far below. Someone asked on bars 29 to 33, would you not say it would have a pullback and a second leg up because you were at the top of a trading range? Well, we have a breakout here, but it's at the highs of a trading range. And then we have a big sell-off. This is big up, big down, probably sideways. And because of that, Bulls who bought, scaled in lower, they're disappointed. And I suspect a lot of those disappointed bulls are trying to get out near break even. And that increases the probability that there's probably sellers not far above. So what about buying the close of the current bar if it closes on its high or at the high of the prior bar? The only problem with that is it's at the middle. It's at a 50% pullback of the sell-off. And that may lead more to sideways trading rather than straight up. The bulls are trying hard to undo the sell-off, 34, 35, 36. And obviously the bears, they are in trouble here. But let's see how 39 closes. At the moment, I still think there's probably sellers above. 39, disappointment bar for the bears. Let's see what 40 looks like. Are we always in long yet? I don't think we're quite yet always in long. Traders are paying attention to see what happens up here. Will the bulls who bought the close of 33 and scaled in lower, are they so disappointed that they'll sell up here, or will they buy more betting on the upside breakout? That is the question. How eager are bears to sell? Excuse me. How eager are the bulls? How eager are bulls to buy up here? At the moment, if I'm a bull and I bought the close at 33 and bought more lower, I'm probably happy that the market has pulled back this much, and I'm probably interested in selling up here. That makes me think that there's more sellers in this area than buyers. But you can see what happened. Traders didn't sell the close at 36. They sold higher. That happens all the time in trading ranges, and the reason that happens is basically the logic. It's the exact same logic I was just explaining. Rather than selling, let me back up. Everything in trading revolves around risk reward. You cannot manipulate probability. You can manipulate your risk and your reward, and therefore that's what shifts probability in your favor. And to carry on with a couple of things Tim talked about, traders need to focus on risk reward. Everybody's interested in risk reward. Ideally, a good rule of thumb is to always have your risk equal your reward at a minimum. But what a lot of traders do is they look at this. They say, okay, 3 big bear bars, second leg down, likely. I don't want to sell the close here because we're in the middle of this trading range. And the middle of the range is a bad area to do anything. So I don't want to sell here and I don't want to put a stop up here and set a target down here because that's bad risk reward. Instead, what I'll do is I'll look to sell a 50% pullback of the sell-off, which is pretty much right here, betting that we'll get a small second leg down before I get stopped out. And if those bears are lucky, we'll get a big second leg down. But with these 2 bull bars, I suspect we're going to go more sideways. I may have been on mute. Bar 40, it's a bad sell below bar 40, but it's also a bad buy above 40. Increases the probability that we go more sideways here. What are the bears going to do that sold the close of 36? I suspect those bears who sold and scaled in, they're disappointed, and they'll probably look to get out around break even on their first entry with a profit on their second. You sell the close at 36, disappointed by the pullback, you scale in higher, and you're trying to get out break even. Sell the close at 3, scale in higher, you get out break even on the next bar. Or sell the close at 3, disappointed 5, get out break even 6. Why not buy the close of 11? Well, the problem with buying the close of 11 is 10. 10 rallied and pulled back. So it's a trend line break, rally and a pullback, and that's a warning that traders are selling new highs. So a lot of traders don't want to buy right at this small high on a smaller time frame. This is a good example why high ones often have sellers above. High one on the 15-minute chart. The high is 14.25, and that's right here. So this is the high of the 15-minute bar. There were sellers above, at least briefly. High ones often have deeper pullbacks and then trend resumption. Low one short right here on the 15-minute. After strong bear bars, there were buyers below for a deeper pullback, then trend resumption down. So traders sell, scale in, get out break even on their first with a profit on their second. So is this sell-off 36 similar to 65 yesterday? Well, there's a few things. One, we've been in a bull channel we've been in a trend, spike pullback channel since all the way down here. We had a bull breakout and then a sharp sell-off rather quickly. And this trapped traders. And then we had a lower probability event. We had a strong rally on 66. 66 trapped the bears. So the way I look at this is this bar, it should have gotten a second leg down. Let me just make the chart bigger to explain it. 65 should have gotten a second leg down. And then 66 reversed up too quickly, so all those bears bailed out of the trade. That would be like if you sell anywhere, 36 or the pullback, and then 37 is a bull bar, and then 38 is another big bull bar. That will trap traders, and that'll make traders disappointed. But if we look at a 1 minute, let's look at a 1 minute chart. Switch my keyboard over. I am still short, and I suspect I have my target a couple ticks lower. I'm probably just going to get out. So pretty much break even, a little bit better than break even on the first with a profit on the second. Bears want to test the close of this line, which is the close of 36. Here's the problem. Bulls buying, so that's a good bar for the bulls. Sell off, rally with deep pullbacks increases the odds of sideways trading. You can see disappointed bears who sold, scaling in, trying to get out around break even. They couldn't quite get down to the low close of 36. Bulls are hopeful they can get a buy and then an upside breakout. So a bull breakout of this bear flag and a rally up to the high of 34. 42, double bottom with 36, but forcing traders to buy pretty high in the overall range. The bears, they'll see it as a possible 3 pushes up, rally to 38, pause, rally to 40, pause, and then a third leg up 43. What about buying above 43? I think it's better to wait and see what the entry bar looks like. Bulls are hopeful that 42 is an adequate test of 36, and that now we're going to rally up to the close of 33. Looks like we're going to test the close of 33. Close is 26.25, high is 25.75. We came within 2 ticks and started to reverse down. So why did that happen? Well, what did I say about traders who bought the close of 33? I mentioned if you're a bull and you bought the close of 33 and scaled in, are you happy or upset? Obviously, you're upset that you bought high in a trading range. And because of that, you have traders now selling out of longs. We may still have to test the 36 close. Good bar for the bears. Wedge, 1, 2, 3, probably a second leg down, likely. 43 is a little bit big, so that lowers the probability for the bears. But if we're going to go down, we'll say 2 things. One, the bears need to trigger the sell. And then the bulls, they're trying to front run and prevent the bar from triggering. But let's see what happens here. Some bulls bought the close of 42, disappointed 43, trying to get out, break even. I think we're going to get a second leg down, and we may try and get this leg one, pause, leg two, down to here. Part of the reason we're hesitating on 43 is it's a relatively big bar in a tight trading range, and it's just above the moving average. Big bars in tight trading ranges increase the risk for traders. And since the risk reward is typically bad in a tight trading range, traders do not like big bars in a tight trading range. Bulls who bought the close of 42, disappointed 43, deciding what to do here. Some will get out, break even. Others will take a chance that we have to get up to the 33 close. It's possible we have to get closer to the close of 33, and that 43 is not an adequate test of 33. Close of 33, 625, the high, 575. We came within 2 ticks. So you can argue 2 ticks is adequate, is enough of a adequate test. Someone said, what's the logic behind trading ranges, traders not liking big bars in a trading range? Because it forces traders to trade in the middle of the range. So rather than selling below 43, a lot of traders try and sell a 50% pullback of 43. Big bars create bad risk reward. If you sell below 43, stop up here, 1 times your risk is right here, and it may not be 60% probability. Bears continuing to fail to get the second leg down. That may increase the probability that we have to go the opposite direction. Not what you want to see if you're a bear. Some bears may exit above this bar. Other bears will wait and see if we can break above the 33 high. So what about buying on a stop above 44? It's still buying high in a trading range above a big bull bar, and that lowers the probability for the bulls. At some point, we will get a breakout up or down. But until we get a breakout, we do not have a breakout. Sometimes trading ranges, you get a sell-off that traps bulls who buy a bar like 33, and then you get a retest of 33. It goes sideways, and then you get a sell-off that tests the 36 close. So I'm still not convinced that we're going to get the upside breakout here. In other words, I'm still not convinced we're going to get the successful upside breakout. Bulls need to get a breakout here. So this is the moment, this is an important price level. What are the bulls going to do who bought the close of 33? Getting the upside breakout. You can see the bears who sold, scaled in, they had a brief window to get out around break even here. So these bears are trapped. The bears that sold this close and scaled in all the way up, they're now trapped. What are the chances that we get a bear bar closing on its low? We might. But 45, big bar. Let's see what 46 looks like. Not the kind of follow through you want to see if you're a bull. And that will reduce the probability that we're going to go a lot higher. Not a great sell for the bears. So we may go a little bit higher. Bulls, they want to trap the bears and get a second leg up after 44 and 45. The bears, they want the opposite. They want to trap the bulls and reverse down. I still think probably sellers not far above, unless the bulls can do something strong here. And it's possible. 15-minute chart, big bull bar. If we get follow through buying over the next few bars, that'll increase the probability that we go higher. So the market's deciding what kind of follow through are we going to get. Some traders, they'll be long, stop a couple points below 44, taking a chance that we're getting an upside breakout. Follow through bar, good for the bulls. Inside bar, possible one bar, possible final flag if we break above, pull back. Probably sellers above. But nobody wants to sell. Traders are going to be cautious as far as selling after a big bull bar, 44 and 45. Too much risk of some kind of second leg. Possible measured move of this bear flag takes you up to 45.31. 15-minute paints this pretty well. Surprise bar, we may get a second leg, and nobody wants to sell just yet. Traders want to see what kind of follow through we get. So even though this has a lot of overlap, the bulls did a good job trapping the bears right here. So the market's deciding if this is going to lead to, if this is a buy vacuum test of the midpoint of this bar, and we're going to get a bear bar closing on its low. In order to do that, we need a bear bar closing on its low right here. So the market's deciding if this is going to lead to, if this is a buy vacuum test of the midpoint of this bar, and we're going to get a bear bar closing on its low. In order to do that, we need a bear bar closing on its low right here. Not what you want to see if you're a bull hoping for the upside breakout. To me, I think the bulls are starting to fail. And the longer we go sideways right here, the more and more bulls will begin to give up, and the more and more bears will begin to sell. Ten seconds left in the close of this bar. Looks like we're going higher. So good for the bulls. The bears, they could not get a strong bear close on 48, and everybody bought it. So that increases the probability that we're going to go a little bit higher. $49, strong enough bar, probably a second leg up, likely. So good for the bulls. Do you sell yet? I would not. I would wait and see more selling pressure. Still always in long and probably going at least a little bit higher. For the bulls, they see no reason to exit yet. They're long and stop somewhere below, and they're taking a chance that we continue to rally. I would get out of shorts below, I'd get out of longs below 51. Too much risk of this being an entire trading range rally. This is why I said I would get out below this bar. 2 or 3 legs up, depending on how you want to count it. And this whole thing is, it looks like a leg in a trading range. It's a channel, but channels typically evolve into trading ranges. 1, 2, 3, several ways to draw it. But a lot of overlap. The bulls, they're still hopeful that they're going to get a measure move up. Maybe that's the measure move target. Now, it's reasonable for bulls to get out of shorts below 51. Does that mean the bears are going to sell below 51? Some might. But if they do, they need decent follow through. Otherwise, a lot of traders may wait to see what kind of follow through we get. Bears, you can see that's disappointing follow through. It's a high one buy above 52, probably sellers above, and at least a small second leg down. I still think the bears that sold anywhere in here are going to make money, so probably sellers up here, and we'll probably test this breakout point. Again, bad high one, probably going to test down here and test the breakout point, the 34 high. Bears sold, scaling in, probably will make money. This whole thing looks like a channel, and channels eventually evolve into trading ranges. Bulls still trying to continue the small pullback trend, but probably sellers not far above. The bears, we had a bear bar on 51, pause 52, second leg down 53, and the bulls are trying to get trend resumption. Always in long, the channel up's tight, but I suspect this is probably going to evolve into a channel, or into a trading range. So we're probably going to start to go sideways fairly soon. Testing the high of 51, probably sellers above. What about buying above 54? Well, it's a wedge. 46, 51, 55. 3 pushes up, probably going to start to go sideways. For the bulls, they still see this measured move as being intact, therefore we may have to get there. My problem here is risk reward. If you're long, where's your stop? Maybe it's below the low of 53, but that is bad risk reward. You buy, you put a stop. You buy at the market, put your stop down here. 1 times your risk is here. And the reality is we're probably going to pull back before we go all the way up here. Trying to break out above a bull channel, but probably going to pull back within a bar or 2. 1, 2, 3 pushes up. testing the measured move target right here. I don't think we're going to get a sharp reversal down, but I do think we're going to start to go sideways at a minimum. It'd be higher probability for the bears waiting to sell below a bear bar. And even then, it's still a low probability trade. You're betting on a trading range, not a strong opposite trend. You can see on the higher time frames 15-minute chart, we're right at the high of this big trend bar, 31.5. We went about 3 ticks above it, and we're starting to turn down. I would get out of the longs below this bar if it closes on its low. Too much risk we sell off and test the 53 low. Bulls, they'll continue to trail a stop, and they're hoping that we continue to go higher. But another wedge, a lot of overlap here, overlap here. To me, this does not look like the start of a bull breakout of a bull channel. Bull channel, measured move up. We're near the top of the channel. Every one of these highs we broke above, pulled back. Chances are we'll probably pull back below this one as well. Measured move from the open of 30, close of 33, takes you up here. Bears have not yet done enough. And until they do enough, we'll probably continue to rally higher. A little bit climactic. Getting near the trend line, but probably sellers not far above and sideways. What I'm getting at is it's a strong bar, 56, but it's probably more of a profit-taking bar than the start of a new breakout. Bull breakout 45 went sideways, breakout 49 sideways, breakout 56 probably going to go sideways. Sorry about that, I was on mute. Leg 1, pause, leg 2, perfect measured move at the top of the channel. First target for the bears, the bottom of 56. Next target, bottom of 53. I'd get out of longs below 57. Big bear bar, probably going to get at least a small second leg down, and we may end up testing. We'll probably get a second leg down, and we may try for a test of the 53 low. Bulls, they bought the close of 56, disappointed 57. I suspect a lot of those bulls will look to exit near the high of 56, trying to get out, break even at the high close. In other words, high one buy, but probably sellers above. Again, most buy climaxes lead to trading ranges and not opposite trends. So I think we're going sideways here. Always in bears, always in bulls, get out below 57. Bears, some bears will sell, taking a chance we test down to the 53 low or the yesterday's high. What do the bears need? What do the bulls need to buy again? This is getting a little bit too strong, and it'll increase the odds of a second leg down. It's becoming like this. We had a sell-off to 36. The problem with 36 is big up, big down, led to a trading range, and the trading range got the upside breakout. Here we have a channel, and this channel is evolving into a trading range. And that's how large channels behave. Bull breakout, pullback, second leg. The second leg evolved into a trading range here. We got another breakout, deep pullback. We formed a trading range, and then we broke out above the trading range. and then we had a breakout 44.45. We channeled up. Now this whole thing's a trading range. So the bottom of the range could easily be the 45 low. And we'll probably get a couple of legs sideways to down. We have a large channel. What are the odds that we test the bottom of the channel? We probably will. And we could go, in theory, we could go straight down. Realistically, we'll probably go sideways. But eventually, if we sell off, we'll probably go sideways and test the bottom of this channel. Breakout points. Here's the 15-minute chart. The high of this 11:15 Central Time, 26.75. That's right over here. Makes me think we're going down to this area. I know it's frustrating when you see these rallies like this. They're channels on higher time frames, and it's really frustrating because it can be hard to buy and hold. But that's how this is how channels operate. Traders sell, they scale in higher, they know they're going to make money. They sell, scale in higher, make money. Even the traders that sold down here, if they scale in, chances are they're going to make money. Is the sell-off to 59 going to be similar to 36? Are we going to pull back like we did to 43 and break to the upside? I don't think so. I think the chances are that we're going to evolve into a trading range. Eventually, the bears are going to get a lower high. And right now, they've got a good candidate. They've got a cluster of resistance. Leg 1, leg 2, measured move. Failed break out of a wedge. Measured move up from the open of 30, close at 33. Right here. You could also do all of these bars. We didn't quite get there. But anyway, 3 consecutive bear bars, 59, close at the midpoint, probably sellers above, and a second leg down. The tail on 59 increases the odds that we may go sideways and bounce. But if we do bounce, I suspect we'll get a second leg down and a test of the 53 low. What are the odds we test the open of the day? It seems far away right now, but if we can break below the moving average with strong bear bars and start to stabilize, we could easily vacuum down to the open. 4 consecutive bear bars. Are we always in short? We might be, but it'd be better for the bears if they can start to get consecutive bear bars closing below the moving average. What are the chances we get all the way down to the low of the day? I think it's pretty low. Obviously, if we start to get big bear bars, that would increase the probability. But at the moment, I think we'll probably test yesterday's high and go mostly sideways. Some bears will exit above 61. But probably a minor reversal up, and we'll probably get a second leg down. For the bears, they need a major trend reversal. Bull trend, trend line break. They need to get a lower high and a second leg down in the start of trending behavior to the downside. They need to prevent a tight bull channel from rallying all the way back up here. If it does rally back up to the 58 highs, it needs to be weak. Some bulls who bought the pullback 57 and 58 scaled in lower, getting out, and bears selling the breakout point, hoping for a second leg down. If 62 closes on its low, it'd be a low one short at the moving average. But I still think we're probably going to get a second leg down. Therefore, I think the reality is we probably will test yesterday's high. We're probably going to test yesterday's high. We'll probably test this breakout point. Why? Because we're in a trading range. We're in a large channel, and channels evolve into trading ranges. We pretty much got a measured move of the opening range, the low of 20, high of 11, basically got a measured move up. Enough of a surprise, probably going at least a little bit lower. We're getting near the 48 low, so you will have some bears taking partial profits. Bears are hopeful this is a measuring gap, and we get a measured move down to the open. Outside bars are typically trading range bars, and the bears really need this bar to close on its low. This is not what you want to see if you're a bear. It increases the odds that we'll start to go sideways. We're getting hesitation at a new low rather than buying. You will have some bears taking partial profits at the 33 high. What about buying right here? I would not. I think the odds are we're going to close this gap. But trading range bar on 62, probably buyers not far below. Testing the breakout point. But probably buyers in this general area, and we're probably going to go more sideways. One of the problems for the bears down here is risk reward. If you're a bear, where's your stop? If you're short, maybe your stop's above the high of the prior bar, but that's really not ideal. And then what about putting a stop all the way at 57? A stop at the 57 high, 1 times your risk is the open of the day. And I don't know if the probability is 60% we're going all the way down here before we pull back. And that makes me think that we're probably going to start to go sideways soon. We may, in fact, go the opposite direction. We may have to rally all the way up here, maybe 45.32, form a lower high major trend reversal, and then try and get a second leg down. So I think we're more in the buy zone than the sell zone. We're more in the buy zone than the sell zone. Some bulls, they buy above 61, buy more lower, get out, break even on their first entry, profit on their second. So if you're a bull, you buy the close of 56, buy more above a bull bar. Break even is the high of this bar, 31.25. Makes me think we're going to go at least a little bit higher. I would get out of shorts above the prior bar. Too much risk. We get a couple of legs sideways to up. And it's possible we have to test the 56 high. So the bears should not have allowed 63. Bulls are hopeful we can get a rally and a test of the 56 close. The bulls who bought the 56 close, 33.5, the market went up to 33.25, and it came within 1 tick of the high close and never let them out. And because of that, you may have some bulls buying here, stop below, taking a chance that we rally to the high close. A trading range is more likely than the start of a strong bear trend. Trading ranges typically have deep pullbacks, which means we're probably going to get a couple of legs sideways to up. You can see we're 2.5 minutes into this bar and we're not going anywhere. And that's a warning that there's not a lot of eager bulls buying above 63. Some bears, they sell the low of 63. They sold all the way at the low tick. They scaled in higher. And they're deciding what to do here. Do they get out at the low of 63? Or do they get out before they sell, scale in? Are they willing to get out, break even on the entire trade? that would create a higher low and a second leg up. Obviously, the third is another downside breakout. Low one short, 64, but probably buyers not far below. Bulls, they're hoping they get another bull bar closing on its high. Channel down's getting tight. That will reduce the amount of traders buying above bars. But if we keep getting bull bars closing on their highs, it'll increase the probability that we have to rally and test somewhere up here. I would get out of shorts above 64. It's an inside bar and 3 pushes down. Increases the risk that we're going to form a trading range over the next couple of bars and test somewhere up here. Good entry bar for the bulls. Increases the probability that we're going to go at least a little bit higher. So good bar 66, let's see 67. Will 67 go straight up, or will it have a pullback, disappointing the bulls who bought 66? So you can see we have a bull breakout right here, and then a channel that evolved into a trading range. So right now we're in a trading range, and this is the range. Let me just go ahead and draw it. This is the trading range, and the market's deciding, are we going to break to the downside or break to the upside? So remember the market cycle: breakout, pullback, channel, and the channel evolves into a trading range. So here was the bottom of this channel, was right here. Testing the top of the channel, or the high of 64, or the high of 62. We sold off down to 60. We pulled back on 62, went down for another leg, and then we're rallying, and this is another tight trading range. So the market's deciding what we're going to do here. Probably sellers above, scaling in higher. And we still may get a second leg down after this sell-off might be tight enough that we still may get a second leg down. This rally right here is a high one on the 15-minute. And I suspect there might. This is the lower high, and it's a high one on the 15-minute. And I suspect there's probably sellers above scaling in. In other words, the bulls who bought up here are so disappointed, we'll probably get a second leg down. Some traders, well, let me just explain what I did, and then I'll explain why. So I bought above, I sold up here, taking a chance we would sell off, and then I got out below, around this bar, pretty much the close of 62. I took a chance and bought below this bar, 62, for a rally, and I ended up getting out. After 66, let me get a sip of water. So after 66 closed, it pulled back on 67 and ended up getting out at the close of 66. And sometimes what I'll do, when you get a bar like 67, I'll try and sell a pullback, taking a chance on a second leg. I'm trapped out here. I missed this move down, and I'm a little hesitant to sell at the market. I want to see how this bar closes. Part of what I'm getting at is right here, I was long betting on a trading range and a test to this high. Here, I was happy about that bar, happy about that bar. But then when this bar started to go sideways, I thought, okay, trading range more likely than a bull rally. And that's why I ended up exiting. And I thought about selling up here. probably going to go sideways in this area. We may get a second leg down, but I think this is part of the second leg. And I still think there's a reasonable chance we're going to have to test up here, 45.32. If you're a bear and you sold during 63, you're probably disappointed with 67, and you're probably buying back shorts somewhere down here. What about buying above, What about buying above 70? It's an inside bar, low probability bar. You can take it for a swing, but I don't think the probability is all that great. 1 times your risk takes you up here, and 2 times your risk is all the way up here. And I think the odds are against a new high. So if you're buying above this bar, you have to take it for a swing. And chances are you end up exiting on disappointment. Bull's trying to get a strong entry bar, but a possible triangle. Is 71 a buy the close bar if it closes on its high? Bull bar, and it's good for the bulls, closing above several bars, but it's still a possible lower high. It's a little bit of a surprise, may get a small second leg up, but I suspect there's sellers somewhere above. Bulls, new high today, but probably sellers above and going more sideways. In other words, probably profit taking up here more than buying. You can see more traders taking profits above this bar than buying. So let's see how this bar closes. It's enough of a surprise. We may get a second leg up, but let's see. The hesitation on this bar is a reminder that something is not quite right with this breakout. We may test the 63 low. What about testing? What about testing the open of the day? And it's probably too far away, but I wouldn't put it against it. I would be out of longs at this point, and I think too much risk that we could get another leg down. So 72, big bar, so big risk, lowers the probability of selling below it, but it's a sharp reversal, and that usually leads to 2 legs down. So I suspect there's sellers above, and we'll probably get a second leg down. If 73 is a big bear bar, and then 74 is another big bear bar, we could easily vacuum down to the open of the day, and that would also take us to the bottom of this channel. So it doesn't look like we'll get to the open of the day, but if we start to get bear bars closing on their lows, we could quickly race down to it. So far, good selling pressure by the bears. Increases the odds we're going to go lower. We test yesterday's high. Strong enough surprise, probably going to get to the open of the day. And what I mean by that is this is a big enough bar, we'll probably get a second leg down. Certainly okay to take partial profits here. And I am short. I have a target 2 ticks above the open. Whenever I'm targeting the open of the day, I always set the target 2 ticks above. And the reason for that is I want to make sure I get filled. So I have a target at 22.75. Even though we may go a little bit lower, it's so late in the day, and this is such a big bar, it's probably climactic. Trading range today, we're probably going to touch the open, but I like to leave a little bit of room. Other traders will stay short, taking a chance. Now, what are the odds that we get all the way down to the low of the day? Well, they're a lot higher than what they were 15 minutes ago or 10 minutes ago. But when I say a lot higher, I am still uncertain we're going to get down there. But I'm more certain we're going to get down there now than I was over here. But again, to make that clear, I think we're going to go sideways around the open. We may pause right before we get to the open. You can see the low, 22.75, and the open is 22.25. So it touched my order, but did not fill it. You have to remember, it's very common for the market. The market typically has to go one tick below your order in order for it to get filled. What are the chances this is a second leg trap, leg one, pause, leg two? I don't think it is. It's possible, but to me, this is a big enough surprise in an overall trading range environment or channel, broad channel environment. Chances are we're going to go more sideways. Big tail on the bar, but it's probably a pullback, and I still think this is such an obvious magnet that we probably will test the open, but it's giving traders a difficult choice. Do they take profits in the middle of this bar, the midpoint of this tail? In other words, right here. Let me show it like this. Do they set a limit order at the middle right here to take profits, or do they stay short, taking a chance we'll get a second leg down? And that is what traders are deciding here. If 74 is a big bull bar closing on its high, I think bears will get out. But right now, I think probably sellers above and a second leg down, and we'll probably test the low of 73. One of the things that's important to understand, so here's the big tail below this bar. Here's a 3-minute chart. It's bear bar closing on its low. So somebody sold the low close of this move. 4-minute chart, big tail. Anyways, we'll just go back, maybe 2-minute chart, 2-minute chart, tail. So let's go to the 3. 3-minute chart, bear bar. Somebody sold, disappointed by the pullback, so they sell, scale in. That's what creates these low ones. So this right here, even though there's a big tail, it's the same thing as this. There was somebody, unfortunately, who sold the low tick of this bar, and they scaled in higher. Chances are the market will allow them out, break even at their first entry. It will allow them out, break even at their first entry. I use the 3-minute as just an example to explain the bar, but I don't really watch 3-minute charts. This rally up to 72, it came within a tick of the measured move target, the low of 30 to the high of 33. It was 34.75, and the high of 72, 34.50. So I think the chances are we're going to touch the open of the day, and then the market will probably decide on the close. This is a great illustration of how high ones typically behave. Let me refresh this chart. So high one, we had an upside breakout, pause. Yesterday was a high one. And I mentioned that there might be sellers above yesterday's bar, at least briefly, and that we would test the midpoint of the bar. So bears sell, and they scalp out near the middle of the bar, and the bulls look to buy. And that's exactly what happened. And then My other thought was there would be sellers not far above. In other words, bulls, if they did buy, they would probably be disappointed and scalp out. High one buys typically have sellers above. So bear bars closing on their lows, good for the bears, probably going lower. Okay, I just got filled. And that'll be the last thing I'm going to do today. So we're at the open, and it seems like a big breakout, but this could easily just be a sell vacuum test of the open of the day. Just like right here, we had this rally up here, and when you look at it, you think, oh yeah, strong rally, it's got to go higher. Well, it doesn't have to go higher. In fact, it can have a very deep pullback. This sell-off right here, as strong as it is, it'll probably get a second leg down. But if you get a bull bar closing on its high, we could easily start to go sideways again. That's why a lot of traders, when you hear Al, he says it's sell to close, but I would get out above a bull bar, or I would get out a couple of points above any bar. The reason for that is protection of risk. Like right here, you don't want to be long and get out all the way down here. There's better examples. You don't want to be long up here and then hold all the way down here. So when you're trading breakouts, I mean, the reality is you cannot, try to find an example. You can't buy the close up here and then put a stop all the way down here and hold through the drawdown. You've got to find a way to be able to exit. So really interesting. You know, these kind of days, when you're in these broad channels, you keep looking at the market and everything just looks terrible. Bull bars, they keep reversing. You know, as Tim said during his entire session this morning, he just had overlapping bars. And that's how channels evolve. That's how channels operate all the time. Broad channels, they're briefly always in long, and then they go sideways. Briefly always in long, sideways. Briefly always in long, sideways. To me, I think we've seen the high for at least a little bit, and we'll probably start to go sideways and test these lower highs. I want to look at the euro versus the dollar. Getting a strong second leg. We may test up here, measure move up from this bear flag, takes you all the way to the high of this bar right here. Odds are we're going to test these prior lower highs and develop into a trading range. Always in long. I thought we were always in long over here, but it wasn't all that clear, and then we got a second leg up. Chances are we're probably going to go at least a little bit higher. Crude oil. We have a wedge. This is the daily chart. 1, 2, 3. We tried to break below and reversing up. You can see it's testing these breakout points over here. So we had a spike pullback channel, or spike pullback channel. We broke below it a little bit here and turned up. So good bar for the bulls. That's probably a strong enough bar that Monday we'll probably get a second leg up. So any sort of lower high will probably get bought. Kind of like this right here, bull bar. I said lower high, I meant higher low. Bull bar, we pulled back, but we found buyers and we got at least a small second leg. Again, this is why I would exit and around the open of the day. I don't want to hold through a pullback, especially in a trading range environment. Let's go back to that 3-minute chart. 3-minute chart, big bear bar, disappointment, second leg down. But the reality is the bulls who bought the close of this big bull bar and scaled in lower, they should be able to avoid a loss. So you buy somewhere up here, you buy more below, chances are you should be able to get out break even, and you probably will be able to make a profit. The other problem I have with selling, and probably the more easier example to think through, is if you're short, where's your stop? Nobody's going to sell and put a stop all the way up here for the next 30 minutes of the day. Instead, they'll use a tighter stop. maybe above this bar right here, taking a chance. But still, even here, what's the probability we're going to go all the way down here before we go up here? And I'm not 60% certain that we're going lower. In fact, I think we're probably going to bounce. So a lot of traders would rather sell pullbacks. Look what happened at this low right here during 73. It immediately pulled back. So what do you think is going to happen at a new low around 75 or 76? And when I say new low, I mean new low of this area, not new low of the day. Plus, think about it from a daily chart perspective. The market's very happy with this price level. Now, when I say happy, I'm implying that obviously it's deciding between whether it's going to be a bull close or a bear close. I'll figure out how to make these a little bit cleaner to see. Green is you can see it's too bright, it's too hard to read the numbers. A little bit easier to see. Again, I think we're probably going to bounce, but you can see what happened. We rallied during that bar. Traders started to sell. And I will look through questions here in about a couple minutes. So I thought, let me do this. So I thought over here, I thought we would get a lower high and a second leg down. Just like over here, we tried to get a lower high. Instead, we broke to the upside. Eventually, the odds are we're probably going to get a lower high on the higher time frames. So 30-minute chart, chances are. It's not really what I'm trying to show. Here we go. You can see big sell-off, rally. It was a lower high. And we'll probably try and test all the way down here. But we may have to go sideways first. This is a great example, actually, of the dangers of selling in the middle of a tight trading range. So 2 big bear bars closing on their lows. But look where it is relative to price. It's in the middle. The middle of the range. The reason why the middle of the range is often a bad area to buy and sell is it's a series of smaller trading ranges. We had a spike, pullback, channel evolved into a trading range. We broke below it. We had a trading range down here. And anyways, the whole point is big bear bars, it's right in the middle of this range. So the probability of the market going all the way down here versus pulling back is pretty neutral. Just like when you get big bars near the middle, it starts to go sideways. Big bars up here, it goes sideways for a lot of bars, forms a bottom, and then rallies. So big bars, dangerous to be selling. And even if you did, that's not the selling you want to see. So a lot of traders start buying back shorts. And that's what caused this rally. This was strong enough to likely get a small second leg up and a retest of the highs. And you can see we got it right here. You can see right here, strong enough rally. Bulls, they buy the close, they scale in, they still make money. This is a great example of the problem of selling down here. Bad risk reward, and bulls that were buying here ended up making money. So what about buying here? It's too late in the day, number one. Number two, you're buying in the middle of this strong sell-off. Some traders might do it, but the problem is, you can see it on a 1-minute chart. If this doesn't start to race up quickly, a lot of those traders will look to exit. So it's racing up, that's good. But you see the tails and the up and down? That up and down is selling pressure. It's bears and bulls selling. And because of that, you'll have more and more traders begin to take profits. That's what we're seeing down here. Remember I said some unfortunate bear sold here and scaled in? Well, some unfortunate bull bought the high of this bar and scaled in. Even though it's a 1 minute chart, maybe they're scaling in increments of 1 tick. Obviously, I'm ignoring commission. But the more the move starts to stagger and go up and pull back, go up and pull back, the greater the risk you actually get a reversal. So far, looking good. So bulls are getting good buying pressure. It's important to understand the structure of moves, how they build. Bull channel, 2 legs down, forming a trading range, and now we're reversing up. We're testing wherever the top of the range is. So let's see what happens. Minute 1, or the first minute, this bar right here, big tail. Look at the second minute, big tail. So are we gaining or losing momentum? Obviously, we're losing momentum during this bar. And if we continue to lose the momentum, that will increase the probability that the market will start to go sideways. I'm not saying you should trade a 1 minute chart. What I'm saying is it's important to understand how price action works. All these tails are failure attempts, and if they keep failing in one direction, it reverses and goes the opposite way. Now I'm just curious to see how this bar closes. We have a tail. We closed at the high of the prior bar. We closed at the high. Now, are we going to close above this high? Or that would be an increase in strength. Or are we going to close under it? And you can see we closed under it. So we're losing momentum. Close above these highs. Close at these highs. Close under these highs. Increases the risk that this is a bear bar or a close at or below the prior bar close. And again, the reversal on the standpoint of a 1 minute chart could be 1 point, pretty small. But that can be helpful to look at and understand. And I'm not saying you should look at this to trade. What I'm saying is you should look at it from the standpoint of how moves form. So it's a small wedge, increases the odds we may go sideways for a couple of minutes. And that increases the odds that this bar is going to have a tail above it. So we still have a minute left in the bar. And let's see what happens. Here you go. The bar is getting a bigger tail. I sometimes reference this, and there you go, reversal down. So that's what traders are doing when they're buying high in trading ranges. They know the odds are against them, but they're buying, and as soon as the momentum starts to slow down, they end up bailing out of the trade. So they buy, then they start taking partial profits out of the whole trade. You see what happened? This is a great example how price action, the time frame is irrelevant. You buy the close, 28.75. Look at the high 2 bars later, 28.75. You bought, disappointed, got out break even. Now, no surprise. You see this breakout point right here? Why do we think this is going to get tested? It's probably, we just closed. So there's the close of the minute, or the stock exchange. That'll make it more difficult to test down here, but we came close. Bear sell, scale in, trying to get out, break even. So we had a rally and a trend line break during this 1 minute and a retest of these highs. And look what's going on. We're pulling back. So let's just see what this high is. High right here, 25.25. And that corresponds to right here, So that's this high right here. And you know the chances are the bears are going to make money. They sell here, they scale in. Chances are they're going to make money. Obviously, it's too late to trade, but it's just important to understand that because that happens all day. Just like the bulls over here, they bought during this big bear bar, scaled in. Chances are they were going to make money. Someone did ask, well, I just saw a question, so I'll answer it. How did I know we were going to sell off? Well, I didn't know we were going to do this. I didn't think we were going to rally all the way to the high. But then there's a few things that happened. One, the reason why I thought yesterday's this area was a magnet is yesterday's high is a high 1 on the daily chart. Plus, we've been channeling up in a weak channel. I thought the odds are we're going to evolve into a trading range. You can see it really well in the 15-minute. We've been channeling up, and obviously this is likely to be a trading range. High 1 buy on the daily chart probably was likely to get bad follow through. And my thought here was when we rallied and then we started to immediately pull back and start hesitating. And then when we started closing down here, my thought was it's a double top. And the bears, any bull who bought up here is trapped. And that was a lot of selling pressure. This bar rallied a good distance and then it was driven back down rather quickly into the close. And at that point, I thought we were in a trading range. So if we're in a trading range, always look for the open. Here's the open, 45, let's just call it 22. We're at 44.31. That's only a 9-point sell-off. And we could easily fall 9 points before the close. But my thought was it would just be a sell vacuum. I'm going to move the screen and then I'll start the review. So daily chart, high 1, but there might be more sellers above. And there were briefly, but we may have to pull back to near the low of the high 1 sometime next week. On the weekly chart, strong bull bar, but overall trading range, and there's probably sellers not far above. This is enough momentum that will probably find buyers below and get a second leg and a test of the July 2023 highs. 5-minute chart. 5-minute chart. Yesterday, we had a lot of trading range price action. And on bar 1, we have a big bear bar closing on its low. For the bears, you can call it top of the channel, test of yesterday's high. It's an okay swing short, but the rally from the 65 low all the way up here is pretty tight, and that lowers the probability for traders selling below. The other problem is risk reward. If you sell to close, that's 1 times your risk. 2 times your risk is all the way down here. So you know it's a low probability trade. And chances are, if you take that sell, you're going to be disappointed. Follow through, bar 2, good for the bears. Some of the bulls who bought the low, scaled in, will be disappointed, but we'll probably get a second leg down. And that's what happened on 3. We tested the 1 low and pulled back. 3 consecutive bear bars, but probably sellers above, scaling in lower, scaling in higher. What about selling the close of 3? I would not. Look where you are. Remember what I've been saying, trading range day, if you're in the middle of the range, usually it's better to look to sell higher or buy lower, but usually this is not where you want to be entering. 4, we broke above 3 and we found sellers. So with 3 consecutive bear bars, sellers above, scaling in. And then outside up on 5, some bears sell the close of 3, disappointed 4, getting out break even or below the low 1 on 4. And what about buying the close of 5 right here? I would not. Probably sellers above, scaling in. With 3 consecutive bear bars, 1, 2, 3, chances are we'll get a second leg down. And we may have to test the bottom of this channel. This low, you could argue that the bottom of the channel is here. We may have to test the bottom. 6, 3 consecutive bull bars, but all overlapping with tails, increases the odds that there's sellers above 6 rather than buyers. 7, another tail. We're trending with closes. Well, I say that we were trending with closes. We're trying to get higher lows, but this looks like a leg in a trading range. And then 8, we made an equal high with 7 and sold off. Probably buyers below 8, scaling in lower. 9, broke below 8 and found buyers during the test of the 3 lows. So bulls buying, scaling in, finding buyers. 11, we had a strong surprise bar. 11, do you buy the close or sell it? Well, the problem with buying the 11 close is that you're buying right at the open and it's 2 legs up and the bar is pretty big. It's forcing traders to buy relatively high in the range. One moment. Okay, I'm back. So 10, big bull bar, but there's probably more sellers above scaling in. It's enough of a surprise, probably buyers below on any pullback, but you're entering in the middle of the range, which is not ideal. 11, big tail below 11, and the body is smaller than the tail. It may just be a retest of the 10 high and lead to sellers above. So consecutive bull bars, but this is probably more of a trading range than the start of a strong bull trend. 12, you can see we sold off again. And look what happened. So the open of bar 11, it sold off and then rallied. And look right here. The open of 12, it rallied a tick and then sold off the rest of the way. So the momentum is drying up. 13, big bear bar, closing on its low. A little bit of a surprise, may go at least a little bit lower, just due to the size of 13. If 14 is a big bull bar, maybe the bears exit, but I suspect probably sellers above in a second leg down. Pause on 14, a warning that the bears are not strong. They sold the close. If bears sold the close at 13, aggressively, we would see bars like 9 and 10, but we don't have that here. And then we have another outside bar on 14, so increased risk of a trading range. Another outside bar, and then bull bar closing on its high right here. What about buying the close? Some traders might, but this may just be a breakout of this tight trading range right here, and it could easily fail. It could just be a retest of the 10 close, the 11 close, and then 18, we triggered the buy above 17 and reversed down. What about buying below 18, betting on a pullback with 17? The problem is you can call it a small head and shoulder stop or trend resumption. So we have a left shoulder, head, right shoulder. You can call it a bear flag. We have a sell-off, 2-legged pullback, lower high. The bears want a second leg down. And then we got 19, really big bar, 19, a surprise bar. And if you sell the close of 19, you're selling at the bottom of a trading range. We sold off on 3, reversed up, sold off on 9, reversed up, and 19, we sold off and reversed up. One of the things that trading ranges do all the time is they try and trick you into selling. Let me say it a different way. What trading ranges do is a lot of times they race to one direction relatively quickly in a matter of 15, 20, maybe a minute or two. They race down really quick, and they make traders panic. They don't make it easy to sell up here, and then as it's racing down, you're being forced to decide, do you sell at the market and take a chance we're going to break down, or do you wait for the pullback? And normally, you're better off waiting for the pullback. Even right here, big bear bar, if you didn't sell it, you still could have sold a pullback. That happens all the time. Even the traders that sold 19, look what happened. It went down, testing the close, near the close of bar 65, and then reversed up sharply. A lot of traders, if they sold 19, and then they saw 20 start to reverse up, a lot of those traders would look to buy back their shorts. What about buying above 20? You can, but it's a big bar forcing you to trade in the middle of the range, and that's normally not ideal. Plus, 8, 7, 19 was a big enough surprise, and the tail on 20 increases the risk that we're probably going to go mostly sideways. 21, doji, probably buyers below. And you can see we triggered the buy below 21, then reversed up on 23. For the bears, 2 legs up, tested the high close, testing the 17 high close, leg 1, pause, leg 2, and the open of the day. But just like the bulls continue to fail up here, just like the bears continue to fail down here, the bulls are hoping that the rally on 23 increases the odds that we're going to fail. It had been better for the bulls if 21 was a bull bar closing on its high. But the problem here with 24 is a second leg up, and that increases the risk that we start to go sideways. 24, bear bar, but probably buyers below, and then obviously we tried to sell off, pulled back. 25, 50% pullback, or you can just call it a pullback from the rally on 20. And then 26, doji bar, it's a second entry buy. It's the entry bar for a second entry buy above 25 right here. But it's a weak bar. And then 26, another bull bar. We have a 3-bar micro channel, good for the bulls, but a lot of overlap. That's bad for the bulls. And then we have a doji bar. It's a bear bar on 28, but no reason to sell yet. Outside bar. So obviously we're in a triangle. For the bulls, they can argue that the bears failed to break out below the triangle. 3 pushes. 1, 2, 3. 1, 2, 3. Doesn't really matter how you want to draw it. What's important to understand is it is a triangle, and we've been trending upwards. 30, surprise, bull bar closing on its high, but we need follow through. 31, follow through, increases the odds we're going to go a little bit higher, but look to the left. We have highs up here, we have highs over here. This could easily rally and fail or form a trading range. 32, so 31, tail above the bar, 32, bigger tail above the bar, increases the risk that we start to pull back. And that's what happened. And then you can see 33. 33 failed to even break that far above 32. And then 34, bear bar closing on its low. For the bears, for the bulls, I think it's okay to exit below 34 or get out a couple of points below, taking a chance we will see a deep pullback. You know, there were bears who sold above all these highs and scaled in. Chances are they will be able to avoid a loss. 35 consecutive bear bars, probably going to get at least a small second leg down. Is it sell to close? I don't know if it's sell to close because I think this is a bear leg in a trading range, and chances are we're going to form a trading range. So the bulls who buy and scale in lower probably will avoid a loss, which means we're probably not going to race straight down. 36, 3 consecutive bear bars, but we're failing to break far below the moving average. And then 37, a bull bar. Chances are there's probably sellers above, and we'll probably get a second leg down after 36 and 37. We'll probably get a second leg down after this pullback. But 36 and 37, low one short, there might be buyers below, and that's why 38 being a doji, that's why 39 could not trigger the sell below 38 and went straight up. For the bears, 39 is 2 legs up, 37 pause, 38, 39 rally, and it's a test of the 34 low. The stop entry, the entry price for the bears. For the bulls, they see the rally from the 36 low to the 39 high as being tight right here, and they expect the first reversal down to fail. And they hope it leads to a second leg. And the bulls, you had bulls buying up here. And those bulls that bought, they scaled in lower. So the bulls are hoping for a second leg up, and the bears are hoping for a second leg down. That's why big up, big down creates a trading range. Bulls and bears are fighting over the direction. Doji 40, but a micro channel lowers the probability of selling. And then 41 bull bar, 42. You can see this bar was important. We sold off testing near the close. So the bears who sold and scaled in, they had an opportunity to buy back shorts around break even. 42, double bottom with 39. What about selling? What about buying above the bar? Some traders might, but there's probably more sellers above than buyers. And you can see 43, big bear bar closing when it's low, but forcing traders to buy fairly low in the range, just above the moving average. There might be more buyers below, and then obviously bears got trapped. So the bears, they sold below and they got trapped on 44, and a lot of those bears started exiting above 44 and bulls started buying. And that's why 45 looks the way it does. Some bears, they sell below 43, they sell more above 44, and then they get out around break even during 45, the midpoint of their two entries. 45, good bar for the bulls, probably going higher. 46, a bear bar, bad follow through, but we'll probably get a second leg up after 45. The risk that the bulls face is a wedge. 1, 2, 3, 1, 2, 3. And because of the selling pressure down to 36, and from bar 1 to 3, there's added risk that whatever rally we get will fail. Bull bar, inside bar, possible 1 bar final flag in a triangle. And then we got a bear bar, 48. For the bears, it's a double. For the bulls, it's a double bottom, 47, 46, and 48. For the bears, it's a second failed breakout of yesterday's high. However, the bears really need a strong entry bar. Otherwise, this may just be a two-legged pullback. It may be a small trading range or a pause after the breakout, 45. And that's what happened with 49. 49, surprise bar, 50. It's the follow-through bar. It's a doji, so it's minimum follow-through. It's still by the close, probably going higher, but this looks like a leg in a trading range. And then 51, we got a bear bar. 51, closing on its low. I think it's reasonable for bears to exit. And there's certainly nothing wrong with getting out. High one by 52, probably sellers above. Reason for that, bulls by the close of 49 or 50, disappointed 51. They get out break even above 52, which is the high one. 53, bear bar, closed above the midpoint. It's a second leg down. We triggered the sell below 51, pause 52. We got a second leg down, 53. And a lot of traders who bought below 52, a lot of traders who sold below 51 ended up getting out at or below the 52 low. They were willing to hold above the first reversal. They're willing to hold against the first reversal, but they're not willing to hold against the second. And that's why 54 looks the way it does. 54, good bar for the bulls. We may go a little bit higher, possible wedge, 46, 51, and then somewhere up here. We have targets above, and we had this measured move target, the low of 46 to the high of 43, somewhere up here. Follow through, 55, still always in long, and probably going to go sideways soon, but no sign of a top yet. And then we got a buy climax bar on 56. 3 consecutive bull bars, and then 57, touch the climax, and then reverse down. 57, it's a sell-off after the buy climax, 54 to 56. 56 is the best bull bar in the rally, and that increases the risk that we pull back. I would get out of shorts below 50. I'd get out of longs below 57. Too much risk of 2 legs down and a test of the moving average. Then you can see 58 tested near the close at 56 and turned down. 57, 58 probably going at least a little bit lower. 59 breaking to the downside, touching near the moving average. What about buying above 59? I would not, probably sellers above. 60, 4 consecutive bear bars. Are there still sellers above? There probably are, but we're starting to hesitate at the moving average. And because of that, traders will start buying below bars. 61, it's a doji, probably sellers above, scaling in higher. And then we went outside down. 62, but we're starting to develop trading range price action here. We have a tail, 59, 60, and 61 all have tails below. And we have a decent rally on 62. And then we sold off again. So that's a variant of a major trend reversal on a smaller time frame. It's a wedge. We rallied, and then we sold off. So it's a lower low major trend reversal. And that increases the risk that we start to go sideways more. 63, bull bar, closing when it's high, but within a tight bear channel. And then obviously, we rallied. We formed a wedge right here. We got a small second leg down, and then a bull bar on 70. And then we rallied back to the high close. Whenever you get a sell-off like this and it starts to look weak, always look for the high close. And the reason you look for the high close is because, generally speaking, if you take a reasonable trade and the market does not let you out, there's usually a 60% chance if you do something reasonable, you can scale in and make money. There's an 80% chance you can scale in and avoid a loss. So some bulls, they buy more above, and then, or they buy here, and you can see what happened. The market rallied, testing the high close. For me, if I'm long, if I bought above any bar, 65 or 66, and then I see a doji, I'm going to be pretty quick to get out because it's a trading range bar, and it increases the risk of sideways trading. 72, we rallied and sold off. That's a strong enough reversal. It's a 2-bar reversal on a higher time frame, and a wedge, 1, 2, 3, 1, 2, 3, increases the odds that any pullback will be sold and we'll get a second leg down. And we may test the 63 low in the open of the day. And then obviously 73, big bar, tested the open. And then we went sideways into the close. But you can see that red line I talked about on the 1-minute chart. Let's go back to it. I mentioned right here that and it doesn't matter that it's a 1-minute chart. This is just how price action behaves. It can be a daily chart, an hourly chart, a 10-minute chart. It's all the same. We had a bull breakout, follow through, and then a bull bar, but tails above. And then we hesitated, and then we broke out. We got a second leg up. But then we had another tail, and what do you notice? We have a bar closing far above the prior bars, and then this closed at the high of the bar, and the next bar closed under the high of the bar. So the momentum is decreasing. Then this bar, inside bar, closes the bear bar, and then the very next bar sold off, testing the bottom down here. And then I mentioned that this red line here would probably get tested because this whole thing is a trading range. And you can see it touched it right there. So why does that happen? It happens because everybody agrees we're in a trading range, or any rally will lead to a trading range. Traders are not interested in selling here, but once the move starts to get weak and get overlapping bars and we're not getting new highs on the close of bars, traders start to sell, and that leads to a vacuum test a vacuum test of support, and that's what leads to the second leg down. And you can see the same thing on a 5-minute chart. And the more you look at charts, the easier that just becomes to process. Always in, not really an ideal, always in day. If you sell below 1, you probably get out anywhere in here. And then I think you can buy above 20. And a couple options, you buy above 20 as 23 rallies and starts to pull back, maybe just get out around break even. If you do, you buy again above 25, or you buy above 20, stop below, and you just hold. But I don't think there's any great sell in here. If you can sell below 18, but with these bull bars, I would not. 30, 31, I think it's an okay buy, betting on a breakout of a triangle. But then what do you do with 34? You probably get out of shorts, or you get out of shorts below 35. And you're right back to break even if you did that. And then at some point, this is pretty tough. Do you sell below 43? You might, but it's forcing you to sell at the moving average, which is not ideal. It's forcing you to sell above the moving average, which is not ideal. and it's a big bar with big risk. But if you did, you'd probably be stopped out, or you'd get out above this bar and bulls buy above 44. And then where do they get out? I'd get out below this bear bar, and you're probably just trapped out, unfortunately, with this. And then if you did not get out below the bear bar, or you bought again above 54, you definitely get out below 57. And then bears, they can sell, or they can wait for maybe you follow through bar, then sell. And then where do they get out? They probably get out above 63. No reason to sell below 64. Some traders might buy above 63, but there's no reason to get out below 64. And then bulls, they can buy here, betting on a test at the top of the channel, and the high close, 56. And where do they get out? Some bulls, if they bought 65, they might get out after this doji, 67, get out around with a small scalp. Others hold. The bulls that did get out, they probably buy again above 70, betting on a second leg up. And then if I was long, which I was not here, I think a lot of traders get out as this bar starts to turn down. And then 72, you may be always in short, but that's more of a limit order trade. And it's pretty challenging to catch these breakouts late in the day. Limit orders, probably sellers above 3, buyers below 5, maybe sellers above 6, buyers below any of these lows, probably sellers above at the open during bar 10 or above 10 during 11, probably buyers below 12, sellers above 14, buyers below 14, probably sellers, even sellers above any of these bars, tight trading range, buyers below, sellers above, buyers on the way down with 19, or as 19 starts to break below 3 and 9 and reverse up, buyers below 21, sellers above 22, buyers below 23. What about selling above 25? Traders will, and you can see, look what happened with 26, 27. If you sold above 25, you had opportunities. You had a lot of opportunities to get out break even. And then at some point, those bears got trapped on 30, and bulls started buying. So limit order bears, if they sold, they probably get out on 30, or they got out on the retest. What about buying below 33? I think it's okay, but you got to be quick to make decisions, and it's pretty tough. Some traders buy below 33, buy more lower, and they get out break even. Over here, you can see low of 33 is 24.5, and then the high right here, 24.75. So it went one tick above and turned down. Probably buyers below 49, 47, but I think that's pretty tough to take. And at some point, there's probably sellers above 60 or 61. And then probably buyers, I thought buyers below 62. It's an outside bar at the moving average, and it's a second leg down when the odds favor a trading range and not a reversal. So we had a buy climax, the odds favored a trading range, which meant buyers below 62. And probably sellers scaling in, but pretty scary to do that. And then I would wait for buy the close, sell the close, really nothing for the first couple of hours. Maybe buy the close 32, 33, but that's right at the high of the range. If you did that, you probably get out around break even, 34, and then buy the close, maybe 45, but probably better to wait and see follow through. And then by that time, there's really no great buy the close bars. If you're buying 49 or 50, chances are it's probably going to pull back, so it's really not ideal. And I would sell the close, maybe 59 or 60 for a second leg down, and that's probably it. So not really great buy the close, sell the close. Let me take a look at questions. Looking through questions. Someone made a comment about going short with the SPY. And I'm not going to say if it's a good or bad idea, but what I'll say is whenever you're shorting an underlying, one of the dangers that traders face is if you're selling, if you just flat out sell, you're margined on the trade. So in theory, if you got a strong gap, much higher than you think, it probably wouldn't. It'd be a very low probability event. I mean, obviously, we're probably not going to gap up 200 points, but you can get surprises that happen. It's less likely with something like the S&P. It's more common with stocks. Target, not really a great example, but if you sold, let's say you sold the close, this works. Let's say you sold the close of this bar and you put a stop above November the 3rd, hoping for a second leg down. Look what happened. The market gapped up from 110 to 25, so you lost $15, and your stop would have been $3 or maybe $4. So you lost 3 times what your planned risk was. A lot of traders, they'll trade the inverse. So I forget what the TLT, I think that might be bonds. Yeah, that's the inverse of 20-year treasury. So SDS, that's a good example. So the SDS is the inverse of the E-mini. You have a low one short rather than the high one. Some traders buy below it, betting on a pullback. I think that's generally a safer idea than flat out selling something like the SPY or the TLT. I think that's the inverse of treasuries. So as the market's selling off rather than, so here are treasury futures, and you can see, I'm not interesting, I don't have data for that on this computer. But anyways, treasury futures, they've been rallying, and if they were, a lot of traders, they will wait and buy. They'll trade the opposite. So whenever they want to sell, they'll trade the inverse because it protects them from downside risk. Okay, back to questions. Are you planning on doing a market cycle presentation? I am. I'm a little bit behind on schedule. So I'm going to make that presentation over the weekend, and then I'll have an update certainly by Monday when it'll be. But I am going to work on that presentation for it. Question recently, Al. The inverse of the treasury was TLT. Recently, Al began to say, so here's a question. Recently, Al began to say, get out above or below 2 to 3 ticks of a bar. Not how he used to say, I'd get out above or below a bear bar or a bull bar. I'm thinking about what if I get in 2 to 3 ticks above or below a swing instead of 1 tick. What's your opinion? No, that's more what I was talking about. A stop entry is still 1 tick above a bar. What Al is more or less saying is this right here. If you're long on 47, don't put your stop below 47. Put it maybe a little bit below 46. In other words, give your stop some distance. We had an example of that. I guess it was yesterday. Here it is. When you get all these overlapping bars, in this case, it was an actual micro channel from 30, so it was 39 bar micro channel. But sometimes you get, we'll find one. You get small pullback, yeah, something like this. You buy the close of, maybe you buy above 15, and then you get a rally to 17, and then you see 19 as being a doji. Don't get out below 19. Maybe you get out a measured move or half a measured move down of the bar. Or if this bar itself is 4 points, get out 6 ticks below the bar. So some traders, what they'll do is they'll say, okay, if I'm a bear, the stop entry is 9 1/4. So 19 1/4, which means the market has to go to 9 even for me to make money. And you can see it really has to go to 8 even, has to go 6 ticks below the low of this bar to make money. And you can see it didn't. It needed to go 2 ticks lower. So some traders will trade like that, putting a stop 6 ticks below a bar. But as far as buying above a bar, it's typically just 1 tick above or below. Here's a great example of a bad high one. It was reasonable to sell the close of this bar. So some bears sold it. They got trapped on the following bar. And look what's going on. They're trying to buy back their shorts at a discount. Well, they're trying to buy back their shorts at a more expensive price, taking a loss on their first entry and breaking even maybe on a second. So They sell here, they scale in, they're getting out closer to break even. That's why low ones often have buyers below. Strong low ones and strong, well, let's use high, let's find a strong low one. Here's a low one. Breakout, pullback, sell, you can call it a low one. There's an increased odds we may go lower. And the reason for that is, let me just find an example so I can show it. Okay, here's a low one. Strong sell-off, deep pullback, low one. We're probably going to go at least a little bit lower. And the reason for that is bears, they sell on the way down, they scale in. If they're really disappointed, they'll buy back shorts early, creating a higher low. If they're not disappointed, they won't buy back shorts. Even right here. Seems very small and insignificant. On some time frame, this tail right here, this tail we've sold off and pulled back. That tail is a pullback, and it may lead to a second leg down. So some bear, they sold below this bar, they scaled in, and instead of exiting at the low close, they'll hold on to their short, betting that they can exit lower. Bar 33 here tested 2 ticks above the high of yesterday. That's right. Does Zzw mention a minimum number of ticks required before he considers the level tested? In the E-mini, I like to see the market test within 2 ticks of a bar. 2 ticks of something important for it to be an adequate test. I was on mute, I just realized. But to answer your question, let me get a sip of water. Okay, so back to the question, does the market always have to come within 2 ticks in order for it to be an adequate test? Not necessarily, but just like with anything, the market needs to come within a couple of ticks of testing it, especially if it's important and obvious. The open of the day is a good example. We came really close within 2 ticks, but normally with this big of a bar, chances are it's got to go and actually test it by at least fall a tick or 2 underneath it. Question, I bought above 25 here. I saw it as a second entry long after 20. I think that's okay. 20 is a big bar, 25 is a pullback. That's okay. Actual stop was below 20 here. Initial stop turned out to be below 25 here. I did not exit at the trend channel line after 42 or 44. Oh, I did exit at the trend channel line up here. That's a good trade if you held that long. That's pretty good. So they bought here, stopped below, they held through this, and they got out up here. That's really good. After 42 and 44, was it reasonable to look for targets with a range from the initial stop or still actual stop? I'm not sure after 42 and 44. Let's just talk about the way I would have managed it. If I bought above that bar, I think it's reasonable to get out a point or 2, maybe a couple of ticks below 34 or maybe a point below 34, betting that if this is the trading range, we could get a fairly deep pullback and you can always buy again. And then as far as, I think it's pretty tough because as far as holding through this is pretty tough. If you're long here and you have a big rally, your risk is 3 points and you bought above the bar at 19, you're basically 18.75 and the market went up to 26. So that's about 8 points. And I would take partial profits along the way and then probably get out below a bear bar. So I think always go back to always in traders. I think always in traders have to get out below this bar or this bar right here, certainly below 35. and it's pretty tough to buy again. Maybe they buy again above 44 right here. So I hope I'm answering your question. Question: if you have a measured move target and the market kind of reached it but didn't touch it and is going in the opposite direction, will you close your position or will you wait until it touches it? Well, that's a very subjective question. So for me, here's my target. Let's just pretend the low of 30 to the high of 33. Market's going up and it came really close, or maybe even now it reached that. Came really close, and then we have a bear bar closing on its low. Am I going to stay long betting that the market's going to retest this close? Well, the problem with that logic is, where's my stop? Am I going to put my stop below 53? That's pretty dangerous. I mean, you would have gotten stopped out in that case. So let's measure where you had to have a stop. You'd have to have a stop all the way down here. So let's think about that for a second. Your target's here. What that basically means is this is how much risk you're incurring from this close, but really from the low of this bar, you're incurring here to here, and your profit goal is not even half of that risk. That's a very dangerous thing to do. So whenever you're risking, you always have to think about your risk relative to your reward. And whenever your risk is so big and your reward is really small, that's usually a warning that something's not right about the trade. That's why traders, as this sell-off starts to go down and get weaker, traders become less interested in staying short because they know the odds are we could easily get a deeper pullback than what traders want. And that's why this happened right here. Was sell the close 33 a good trade? You could sell the close at 33. For me, I'd rather wait. I thought probably buyers below in a second leg. But traders were selling the close at 33 because it was at the high of the trading range and the momentum was starting to stall. So it looks like that is it for questions. If I missed any, I'm going to talk about the daily chart for a second, but if I missed any, comment and I'll talk about it. Daily chart, what do I think is going to happen on Monday? Monday, we have this high one, but we're losing energy up here, and I suspect we're probably going to have to get a deeper pullback than what the bulls want. High one, good for the bulls, but buy climax, overlapping bars, buy climax. I think we'll probably get a deeper pullback than what traders want to see. Now, next week is Thanksgiving week, and I believe, obviously, Thursday, the market is closed. I think Friday is a half day, and Wednesday, I'm pretty sure Wednesday is a full day. But anyways, people always say the volume can be slower, and that's true. But I would focus on next week being very disciplined and letting, if the range is slow and you get a lot of this, be sure and be disciplined and not in too much of a rush. So trade the chart in front of you, even if it's not what you want for that week. You cannot force trades. Okay, last question of this webinar. Why does price return to breakout points so often? That's a good question. The reason why price returns to breakout points is limit order traders making money. So what do I mean by that? Bears, they sell above 3, scale in, make money during any of these bars. You buy below 8, scale in lower, you make money. You sell above 9, scale in higher, and you make money. How do I know this is true? I know it's true because, for one, I've done it, And number two, fade. Go ahead and buy above bars and put your stop at break even and see how often you get stopped out. And it's going to be on almost every trade. And the reason for that is most of the time you can fade breakouts and scale in against the breakout and make money. The dangerous part with that is if you're not careful, something extreme can happen. So let's say you sold anywhere over here. You sell, you scale in, you scale in, scale in, and maybe it comes really close to break even, but it does not let you out. And you hold through this day, and you just say, you know, screw it. It's a trading range. We'll probably sell off tomorrow. I'm going to hold overnight. And then you wake up, and the market went from 26 to 86. So in other words, you're down 60 points after you've scaled in, and you're probably leveraging the account. That's the danger of scaling in. Or look at this day. You see a bear leg in a trading range, so you start selling, selling, selling. You get trapped and you just keep selling all the way up, and you take an incredible loss. But most of the time, it's the opposite. Traders buy, they scale in, they make money, buy below bars, sell above bars, make money. And that's why breakout points often close. It's because limit order traders make money most of the time, or they can at least avoid a loss. Okay, thanks everybody for watching. Hope everyone has a good weekend, and we will see what happens on Thanksgiving week. Take care, everybody.